Teasing, toying, turning, chatting, charming, hissing, playing the crowd. Play that song again. Another couple clown up in another glance, a half-hearted bow. Oh, such grace, oh, such beauty. And lipstick and callus and fishnets and malice. Oh, darling, you're a million ways to be cruel. You're a million ways to be cruel. You're a million ways to be cruel. I wish I could. Maybe if you were, I would a list of standard issue regrets. One last 80 proof, slouching in the corner booth. Baby, it's as good as it gets. Oh, such grace, oh, such beauty. So precious, suspicious, and charming and vicious. Oh, darling, you're a million ways. Oh, darling, you're a million ways to be cruel. You're a million ways to be cruel. You're a million ways to be cruel. Oh, darling. Oh, darling. You're a million ways. Oh, darling. Oh, darling. You're a million ways. Oh, darling. Oh, darling. You're a million ways to be. You're a million ways to be cruel. You're a million ways to be cruel. You're a million ways to be cruel. You're a million ways to be
Please take your seats. Our program will begin in 10 minutes.
Spent the night without
Please take your seats. The program will begin in 5 minutes.
Between my lungs, and when my knees won't shake, I'll drink to find inspiration, 'cause I'm a red-blooded man, but I can't see behind the sun, a supernatural plan is coming to meet me now, living life with no need for the brakes. Something happens when I lean on my mistakes. Love is mystical, love will break the chains. You might feel invincible, you might be afraid. Light and darkness will show you the way. Give you the power to believe again. 'Cause I'm a rational man, and I can see how far I've come, but I don't know where to stand. Who's coming to meet me now? Living life with no need for the brakes. Something happens when I lean on my mistakes. If the words are true and the words reveal the sin, I come alive when I don't even think. Love is mystical, love will
Please take your seats. The program is about to begin.
you might be afraid. Light and darkness will show you the way. Gives you the power to believe again. Oh, can't you hear the future is calling? For heaven's sake, it's either hell or high water. Let's get out of this place. I feel your
Please take your seats. Our program will begin now.
It's been a summer of discontent for the global economy. Inflation is at a 40-year high in the United States and showing few signs of cooling. After initially calling it transitory, the Fed is now vowing to keep at its battle to bring down inflation.
At today's meeting, the committee raised the target range for the federal funds rate by 0.75 percentage point.
But the measures don't come without collateral damage.
Everyone thinks the Fed can handle this. That hurricane is right out there down the road coming our way.
With talk of recession looming, volatility continues to grip financial markets. Some say a hard landing now seems inevitable. So what phase of the downturn are we in? Where does one put money to work? We asked the biggest names across finance and economics how the current environment is impacting asset management, venture capital, crypto, private equity, real estate, and more. This is Bloomberg Invest.
Please welcome to the stage Bloomberg Odd Lots co-host Tracy Alloway.
Welcome back to Bloomberg Invest. Congratulations to everyone who successfully made the trek from the 29th floor back here. Your reward are plenty of more sparkling conversations. We're going to be talking about everything from markets to private equity, sports, crypto. We're going to have a conversation with the star of HBO's hit show Industry. Has anyone been watching that? Yes, everyone's excited. Okay, excellent. Hopefully you're as excited as well for the live recording of Odd Lots that we're going to do with Pantera's Dan Moorhead. That is a live recording, as I mentioned, so we will ask at that time if you could please make sure your phones are silent. Please try not to, rustle your coffee cups and your clothing as much as possible. Reminder to our virtual attendees, if you experience any issues with audio or video quality, refresh your browser. Use the chat box at the bottom right of the corner screen if you need additional support. We also have a real-time transcription service. You can find that in the link in the corresponding sessions on the platform. If you're in the audience with us today, as clearly many of you are, you'll find the Wi-Fi information on your badge if you need it. And whether you are here in person or joining us virtually, we do want to hear from you today. So please take out your phones, scan the QR code just there. We'll be doing live polling throughout the day. We'll also be offering you a chance to submit some questions to our various guests. We'll try our best to get to those, but this is really your chance to participate in the event. So please scan the QR code there if you can see it. You can also type meet.ps/BloombergInvest in your browser. We'll be flashing this throughout the event, so if you miss it now, you will get another chance. I think that's it in terms of housekeeping. Thanks so much. Hope you're enjoying the day, and I will be seeing you all again in a few minutes. Thanks.
Please welcome to the stage Saba Capital Management founder and chief investment officer Boaz Weinstein with Bloomberg's Barry Ritholtz.
All right. So this is the first time I'm wearing a suit and tie in I don't know how long, and I'm glad.
He didn't tell me about the tie. Sorry, guys.
So we previously had a conversation. Was it earlier this year, last year? I can't even tell anymore. And there were a lot of really interesting things that came up. I think this audience would love to hear an update on what's happened since then. But I have to start by asking. You were a highly ranked chess player as a young kid. You have a reputation as a killer poker player and a dangerous blackjack player. These involve making probabilistic assessments about an inherently unknowable future. Seems like you've been setting yourself up for tail risk and derivatives and trading since you were a kid.
You're giving me a lot of credit for having planned everything since I was 5. I think the only tail risk I was thinking about when I was 5 was pin the tail on the donkey, to be quite honest. So really I enjoy games of strategy, And it turns out that Wall Street is the ultimate puzzle and challenge. And so, yeah, so I've been working on Wall Street since I was 15. And I think at a young age, I'd already seen a lot.
So let's talk about what's going on right now. We've discussed, and you've brought up, how different this bear market has been from recent bear markets. What are the similarities? What are the differences? What makes 2022 so unique?
Yeah, so when you think about not only what's happened, but even the investor behavior that it engenders, a lot of the tail events that I've lived through, I was trading while 9/11 happened. I was at the New York Fed the weekend that Lehman was failing. A lot of those events, not all of them, but a lot of them were bolts from the blue. COVID, you kind of had a month from when people knew it was a thing before the market started falling. But they were bolts from the blue, and if you had not done anything about it, you had plenty of air cover to say, who knew? Who knew this would happen? What could I have done in advance? Whereas this one has been so telegraphed, when it, at least the initial part of it about inflation being transitory, and then transitory, and then transitory, and then not transitory. So there was a lot of time in 2021 to get worried, and very little places to hide to say, you know, it was not reasonable to have thought, what if this 40-year bull market in bonds not only comes to an end, but does a sharp reversal? Those were things that we and other managers were talking about, where the 60-40 plans that were using treasuries as their, you know, as their antidote to a sell-off, it turns out the treasuries were the poison. And so, you know, this has been different in that respect. It's also been different because you have so many different problems swirling around, some of them in conflict with each other. So solve one at the expense of the other. And then the number of new things showing up, whether it's, you know, maybe untoward rumors about Credit Suisse or what's happening in the UK gilt market, it just makes the number of balls in the air enormous in terms of things, known unknowns that could really cause more than a sell-off, but more like a crash.
So let's talk about that. You've discussed multiple problems in multiple areas taking place at the same time. How do you distinguish between what's a genuine risk, what's a known risk, and what's truly an unknown?
So usually you have your known unknown, like something's bad, we just don't know how bad, and you can respond to it. So, you know, 9/11 happens, it's not a good time to buy airline stocks. You know, COVID happens, not a good time to buy airline stocks. 08 happens, probably you should de-risk from financials, even like the moment after it happened. And here, you just don't know exactly what to do. So normally, for example, European investment grade trades 5 basis points lower than US investment grade. Now it trades 30 basis points higher, 25 basis points higher. Is that enough? Europe's going to have a much more severe recession, according to those that pontificate. And so whether or not you underweight or overweight Europe is all about what do you think happens with Ukraine? Is there a chance it gets asymmetric? What can be done to mitigate? And then at the same time, you have these other theaters, whether it's zero COVID policy in China, maybe extending well past the Party Congress, continuing to cause disruption in the economy. So really what's happened is people just feel risk all over. They've felt it now for 10 months, and they're de-risking the things that are in their book. And that has led to some things that I don't view as particularly risky, blowing out as much as things that I do view as risky, and that's created some interesting distortions, interesting opportunities.
So let's talk about those opportunities. What has been overly de-risked? What are looking attractive after investors throw the baby out with the bathwater?
Right. So not knowing where to focus your arrows and instead just focusing on de-risking, and the comments that Jamie Dimon made about bracing for a hurricane, and another CEO said bracing for a tornado, and someone else mentioned some other weather disaster. You know, like, what do they actually mean when they do that? How do they actually brace other than, like, you know, other than a physical brace? What are they doing? They're a bank. They have loans. They go to their loan portfolio hedging group and they say, please increase the amount of hedging. So what does the bank do? It looks at the loans that it's made, often to the best companies in America or in the world, and de-risks where the risk is. And so we did a number of trades with banks where they're coming to us to say, in the middle of all this, we want to buy protection on Coca-Cola, on Johnson & Johnson, on Home Depot, Walmart, you know, AT&T, Verizon, these big companies that have a lot of debt outstanding in terms of revolvers, and not relative to their balance sheet, but relative to just the quantity of debt. And so there are a bunch of names, in fact, I think everyone I mentioned, where if you look at where it is today, it's above the worst day of COVID. So those names that are not even candidates for discussion about could they run into trouble as credits are above their worst day of COVID, whereas the index that they sit in is only trading at 2/3 of the worst day of COVID. Why would those names be worse? Why would they be at the widest levels and the average be only at 2/3? It's because of this technical in the market, and I think technicals are the biggest force in the credit market now, much more than fundamentals, much more than any time in my career, where if somebody has something to do, which is to buy billions of dollars of Verizon 1 year or 2 year CDS, that's going to move the price to levels that just doesn't make sense from a fundamental point of view. And so what we've been doing is going long those names, selling that insurance to fund protection on companies with a history of blowing out if actually there is a real recession or some other kind of crisis. And so that would be found usually in consumer finance companies, economically sensitive companies, cyclicals, steel, shipping, paper. And so we've found it very interesting in the middle of this problem to be able to find attractive long-short trades because of the technical distortion.
So are you looking at the fundamentals of these equities? Are you looking at the technicals of how they're trading? Or are you looking at the credit spreads and saying, hey, people are way too frightened beyond what they should be?
Yeah, so we probably more than most on the credit side do look at equities for clues, and sometimes there is one market above faster or slower than the other, but we're sourcing the tail protection that we provide our investors, which is one of the main things we do, through the credit market. And we'll get to that, I'm sure. And we're paying for it because there are many investors that want it paid for. They don't want to just bleed the negative carry through some of these I view as ultra low risk trades in Verizon or Coca-Cola.
So do we want to get more specific? Is it strictly an equity bet, or is it equity combined with some derivative? How are you putting together these paired trades?
So you could look at the history, and first you could use common sense and say, is this the kind of company that could run into trouble? Is it not? And the price is not efficient compared to the past, where fundamentals were the biggest driver. We're looking at the credit, a little bit about the fundamentals, but the fundamentals are sort of not in question on the long side. It's really, have these served us well and investors well as tail hedges in the past? We look at 08 and 2020, 2012, and say, is this the kind of company that regularly blows out from 100 basis points to 400 basis points? Take General Motors, for example. They defaulted in 08, problems with the UAW behind them. They've still been enormously volatile as a credit, as a company super exposed to the US economy and the global economy and the pressures. The credit in 2020 went from 100 to 700 back to 100. And it's had that kind of roller coaster. And so we look at it and say, that's a really volatile credit. And when it's low, that's really asymmetric. You could buy protection, and if things change, it might move out a lot. Right now, it's at 250. It has moved out a lot more than the index. And so we're looking at histories to give us a clue. We're looking at forward-looking models, equity vol, fundamentals. But what we're at the end also doing, and I should make sure I say this, is we're providing liquidity to the banks that need it. And if they come and say they want to buy protection on Pepsi or LVMH or Nestle, that's amazing. You've now given me the ammunition I needed to go and fund protection on companies that really may run into trouble.
So let's talk a little bit about history. You mentioned 08 and 2020. We can also mention 2000 in the same sentence. That were fairly rapid and disorderly dislocations. Maybe 2020 might be the exception. This, you've described 2022 as sort of a slow motion implosion, and yet it's still been very orderly. What makes this year so unusual compared to previous collapses that really seem to make a bottom and snap back pretty abruptly?
Yeah, so first, the market is still trying to figure out what it should most worry about. And so, it's like just when you think something, maybe we're at peak inflation past us, maybe the supply chain problems are coming down, but then you have new things. And so there's just been this sell-off that continues to find new rationale. And then you have the Fed leaning on the market, actually. And when Powell sounded too dovish, first all of his peers came out to say, no, the market, we're going to keep going. And they've continued to say that, Kashkari most recently. So you have the Fed kind of intent on showing that they mean what they say. And so and probably liking that the market is going down on an orderly way, even if it's created some disorder in other markets. Look what's happening in the UK. And so I'm used to, and we're all used to, sell-offs that are fairly quick, that we know. Even '08 was 5 or 6 months from Lehman to the lows of March '09, where at the end of it, you can kind of wonder, is there an all-clear sign? We have the Fed behind us, quantitative easing. Now we don't really know who the savior is, because at the end of all of this, we're still going to have quantitative tightening and shrinking the balance sheet. And so whereas a lot of sell-offs were just a prelude to a bull market 1 or 6 months later, this has the feeling to me like we're going to be worried about some number of these things or new things for potentially quarters and maybe even years to come.
So no capitulation yet, no flush, which gives us that all clear signal. How much of that is based on truly not knowing what the Fed's going to do, or is it we don't know which potential problem is real and which is fake news?
These things are so hard to predict. I even want to be cautious about opining too much, because it's just such a confusing market, and there hasn't been a single thing to say, okay, this is why why 20% is not enough. It should be 40. Let's take inflation. If you look at forward inflation, it's expected to come down a lot. So you could look at tomorrow's CPI print, if it comes in a tenth or below or high, and get excited about it. But the market is still telling you inflation is not going to be the problem that it is 1 year from now. Now, if a few months from now that conviction is shaken, then we're going to have a real strong sell-off. If somehow Russia, heaven forbid, becomes more asymmetric, we're going to have a real problem. And so we just don't know. We're in a fog, and we should not rely on the lessons that people learned maybe incorrectly for this environment that were good between '08 and 2022, which was the Fed is your put, don't fight the Fed, and dips should all be bought, and being short is fighting the Fed. This really does not feel like that environment, in particular because of where the central banks are versus then.
But the one lesson that should carry through sounds like continue not to fighting the Fed when the Fed reverses their position.
I'm glad you said that, Barry, because about 9 years ago, I had a prospective investor in my office. We're a long vol fund. One of our main products is long volatility. And I don't know if he didn't quite know that, because he kind of wagged his finger at me and said, almost like Sonny, didn't someone ever tell you don't fight the Fed? Because to be long volatility, when Mario Draghi said, trust me, I'll do whatever it takes, that's a little, right. That psychology of don't fight the Fed, don't be short, is, in my opinion, a lazy person's way of saying let's always be long. Because if that person were around today, I don't exactly remember who it even was to make that call back, I'd say, if you really believe in don't fight the Fed, how much of your risk did you take down when the Fed said that they really meant business and we're going to be selling assets for years to come, and plus all of these problems that, when you add up the number of problems in different theaters, I can't think of a corollary that, to me, it does feel worse in many respects than any other experience in the market I've had.
So you hinted at UK gilts and what's going on over in London. The strength of the dollar is another factor. How do you think about those when you're considering tail risk and volatility? So
we're not experts in foreign exchange, but I look at the gilt market, for example, and you see like the UK 0.5% bond of 2061. Somebody, in 2021 bought a 40-year bond that was going to pay, not someone, a lot of people, is going to pay 0.5% a year for 40 years. And at the end of all that, the most you could possibly make was 0.5% times 40 minus some inflation, and that would be 20 points without discounting, without inflation. The thing's down 73 points. So when you think about boundary conditions, and what I like to do in the derivative markets is look at boundary conditions and say, how much can I make, how much can I lose, and where is there some asymmetry? And by the way, we were not short any UK bonds, to be clear, but there are a lot of trades that looked like this kind of, I can only lose a little bit, but just in case it's not transitory, or just in case there's an unknown that is really problematic, you might be able to make 8 to 10 or 20 times what you might have lost. And to see this move, and it may continue, of higher rates, whether it's the US or Europe, where the investor loses 3 or 4 times what they could possibly make at the end of the day with bonds, I think it reminds me of how investors don't really think about fixed income and equities in the way that I do, which is, equities gives you this unbounded upside. It could be Tesla, it could be Faraday Future or Fisker, but you're minus 100 and you're plus 20,000, and that's the range. But in fixed income, often there's so little to earn that when I see my peers talk about high yield at 5% is amazing because it used to be at 3%, I feel like, wait a second, how many defaults do we expect this year? There's a lot of companies in that index that are going to run into trouble. So what are we really, how excited can we really get just because high yield is, has widened by 2 percentage points? And so I think fixed income can end up effectively being an option, but people don't look at it as an option. And I view it often as an asymmetric short, and that's one of the guiding principles of our tail hedge strategy.
So let's talk about another credit-related issue. A couple of weekends ago, people were talking about the widening credit defaults on Credit Suisse, and surprisingly, you came out and said, "Everybody, catch your breath. Credit Suisse isn't Lehman Brothers. Just look at various ratios." What made that so attractive to shorts, and what led you to the conclusion that Credit Suisse was more or less okay?
Yeah, I didn't start out thinking I want to say something public. I basically have 0 Twitter followers before this. Then all of a sudden, it became a thing. I noticed that people with hundreds of thousands of followers were saying Credit Suisse spreads are at their decade high. It's an imminent bankruptcy, imminent default, according to secret sources. And when you see like people with 100 followers saying that, fine. But when you have kind of at the same time, you could almost read that it was the same person sending it from accounts or team with hundreds of thousands of followers, that this sounds like scaremongering. It sounds like someone trying to make something about it. And well, what do I know? I know that this quote, it's at a decade high, can be used as fake news to say, therefore, it's going to default. But if you look at the spread, at the time, the 5-year credit spread of CS was 2.5%. Now, if it defaulted back to our boundary conditions, it could go to 0, it could go to 50. It would be like 2.5 to lose or make or lose 50 to 100. It's still priced like 25 to 1, right?
Low probability.
Very low probability, but it's discussed as something that's about to happen. And so I kind of took offense to it. I'm supposed to know a thing or two about CDS, so I wrote a little bit about it. And then I posted Coca-Cola, by the way, also at decade highs, better stock up on Coca-Cola. And we had, articles come out saying that I was saying Coca-Cola may go out of business, which, reminded me about sarcasm and how it doesn't necessarily translate to at least some of the users. But this point of, something's at a decade widest level, therefore crisis. I took offense to it, and I don't have any special connection to Credit Suisse, but I felt like weighing in.
And so far, Credit Suisse still hanging around, right? Has yet to default.
I did get some very nice messages from the fine folk at Credit Suisse. So yeah.
So since we're talking about tail risks, let's talk a little bit about that and hedges. Why have equity puts or VIX calls so disappointed this year as insurance?
Wow, that's a brutal question, actually, because there are people, it's like if you say, look, I didn't study hard for the test, I didn't do well in the test, okay, mom, dad, whatever, study harder. But when you study hard and you say, I'm going to be prudent, I'm going to buy tail protection, I was there in January to buy it, and then it doesn't work. It's like, tail hedges have to be reliable because they serve a greater purpose. It's not just how did this manager do unto themselves. It's I was counting on this tail hedge to do me some great service in my portfolio. And I think the really interesting thing is that the VIX is cited all the time as the barometer of fear. Well, so I remember, and probably many of you remember, that in the period, let's say 2012 to 2019. We even talked about there was a single-digit day for the VIX. It went below 10. It was often between 10 and 12 in good times. But something happened after 2020, which is, we had COVID and that enormous volatility. It actually destroyed the people picking up nickels in front of the steamroller, AKA the short volatility crowd. They were no longer there after March 2020. And then came a new breed of investor that loved to buy options, whether it was options on meme stocks, and you saw the volatilities go nuts there. SoftBank set up a unit to buy options on on tech stocks. And culturally, I think in this country, on the investing side, things became fast. Think about, when your friend, because it wasn't me, would tell you that some NFT went up by 10x, and you'd say 10x. I would like 1x in 5 years. I'd be really excited about that. And everything became fast, and options are a way to get there fast. So, long-winded way to say, when we came into 2022, the VIX by prior measures was already at a 4-alarm fire. We were at like 22 to 28 on the VIX, and that kind of number would have been a bear market the prior decade, but we were at the peak for the S&P. So tail protection through equity options was incredibly expensive, and it has served investors very poorly, whereas credit spreads came into the year near the lows that they were pre-COVID. They've widened, and they've done their job, even if there's still a lot of widening potentially to come.
So let's dive a little deeper into that. So the end of 2021, peak bull market, and the VIX very, very high. So how are investors supposed to put 2 and 2 together? What did that signify?
It meant that if you said, I'm going to spend a certain amount of premium, like you think about with your car insurance or auto, home insurance, say, I have this much premium, I'm going to buy a put struck 5% out of the money or 10% out of the money. If I'm right, if this insurance was good to buy, what kind of payoff profile would I get? And you were getting nothing like you would get, not just pre-COVID, but over the past, let's say 20 years, you were getting pretty miserable payouts for a bull market. When times are rough and vol is high, you understand why you have to pay a lot. But coming into this year, vol was stubbornly high, and so equity options were extremely expensive. We did a webinar for our clients where we showed that basically across assets, Bank of America put out some neat research that had the S&P and the NASDAQ as literally out of 50 assets, the 2 worst you could get interesting payouts from. And so those things are not necessarily undecipherable, but credit, in every sell-off, credit has blown out, whether it's the credit crisis, of course, but even the flash crash. I remember being surprised that I was trading during the flash crash, May 2010. Maybe I'll get the date wrong by a little bit. And credit spreads, because of a glitch on the New York Stock Exchange, moved that day almost as much as they did the day of 9/11. So credit is an option. This low spread thing can move a lot. You can get an option like payout being short or be exposed to the loss being long. And it is, in my view, a much more reliable tail hedge that's been backed up in academic research. And it also stands to reason that credit is an option, whether you look at a Merton model or you just think about, I'm taking this little spread in return for exposing myself to a wider credit spread environment or defaults. And this is why I feel very fortunate that my sandbox, where I grew up in the credit derivative market, is a really viable forum for tail hedging.
So I have a last question before we go to audience questions in the last few minutes. Given where we are, how wide have credit spreads gone? And if the put side wasn't attractive on equities at the top in the market, how does the call side look on equities today?
So credit spreads today are, in absolute terms, they're slightly elevated. Like, let's say it this way. Remember December 2018, Trump and Xi were having a skirmish. The Fed was, being was being tough on the market while growth was faltering. That seems like a walk in the park compared to now. And credit spreads then were roughly the same as they are today. So maybe they shouldn't have been that wide then, or maybe they're too low now. But spreads now are elevated, but in my view, nowhere near what the risks, the hidden risks and observed risks are in the marketplace now. In terms of call options, there's moments where credit falls enough that it isn't asymmetric, that it's symmetric, or it looks like if you locked it away in a box, you're going to get a high return compared to defaults. We're not near that yet, and I still believe equities are much more attractive long, even though there's going to be this sort of technical of people looking with loving eyes at a 5% yield or 6% yield, and you can find in some investment grade corporates 7 or 8% yields if you go out far enough on the curve, and so there will be probably some people saying, I want the certainty of that yield, but that also comes with plenty of interest rate risk.
Yeah, to say the very least. All right, a couple of questions from the audience, starting with, where do you see the largest realignments of capital coming in the next 5 to 10 years? I don't know if that's really your sort of question, but
I don't even know what's going to happen in the next 5 months. So 5 years, with respect, I really don't know. But what I do believe is that the QT world, when all this is behind us, there's still a giant balance sheet. There's a headwind to the market. Is going to be really brutal for investors that have survived.
Meaning
from
$4
QE.
trillion in Fed assets that have to come off the balance sheets.
Just in the U.S., and maybe they'll go slow or less slow, but I think this is going to be a period of much higher volatility than the last decade was.
So future volatility is going to increase, whereas it was modest but not low over the past decade.
Yeah, there were punctuated moments, but there was a long period of very low volatility, and it seems like that may be behind us, because even if some of the problems go away, you still have the undoing of QE, which is more than just no QE. It's the opposite of QE, is I think a really underrated continuous headwind.
And final question, and I'm going to modify this. Given where 10-year Treasury yields are today, what does that mean for future GDP growth? What does that mean for the possibility of a recession, either mild or more significant?
So, until March, there really weren't any banks calling for a recession as the most likely case. It was around then maybe one or two banks. Obviously, Larry Summers and others did speak out. I think that these kinds of forecasts are really folly. Literally, we're standing in a thick fog trying to play tennis, and we can't even see the ball. So when I hear people, and by the way, that's a great question you asked, but when people answer it, I kind of shudder. So I'm going to try to not shudder at myself and say, who knows? But what I know is that we should be aware that this is not the market we were in, and this idea of thinking, I can feel this thinking of, as soon as CPI misses, as soon as we come in at 7 something, okay, it's going to be off to the races with the market. I feel like this is a, personally, I think it's a sell the rally market, because people are not yet accustomed to all of the issues hanging over us. And anyway, that's my 2 cents.
All right. Thank you very much, Boaz Weinstein.
Please welcome to the stage Crypto.com Global Head of Institutional Sales, Sebastian Govenda, with Bloomberg's Michael Briety.
Thank you. My name is Michael Briety. I am an FX and crypto market specialist here at Bloomberg, and I'm excited to be joined today by Sebastian Govenda, who is the Global Head of Institutional Sales at Crypto.com for Crypto.com's sponsor Spotlight, Crypto as an Integrated System. Now, you and I spoke earlier in the week. Welcome, first of all, welcome. Thank you for joining me.
Thank you.
You and I spoke earlier in the week about this title, and we were discussing that a little bit. So I think a good place to start would be just going through that title and why you chose that was your choice.
Yeah, definitely. Thanks, Mike. It's great to be here. And I think for us, it really comes out to perspective. So for Crypto.com, we're a global tier 1 platform and ecosystem. We have more than 50 million clients, spanning the range from beginning retail to sophisticated institutions. And for us, I say that not as a sort of piece to go ahead and pat myself on the back. It's about, what does that provide us in terms of insights? Because we're in this sort of incredible intersection of what clients are able to sort of do and see, and we get to see what works and what doesn't. Sort of the same way that lawyers, attorneys, consultants get to go ahead and be able to have some sort of that sneak peek insight, which is extra exciting for me. I won't nerd out and talk about all those details in super nuance just yet. But that's the part that I find super interesting. And so when it comes down to all the services that we offer and being able to see how people go ahead and interact with, let's say, the exchange piece that I work on, or maybe the payment platform that deals with crypto payments, stabilizing values, the NFT marketplace, the yield products, all these sorts of things. It's about how does that work together. So it's a really sort of long-winded way to say that the integrated service component, integrated system, when we see that and we see what's working, what isn't, for which clients is it working, and which ones is it not, it's the ones that take a little bit more time to ask a few more questions. And so when you ask some of those questions, I think then you're able to kind of figure out, how do I actually use this? How do I do it in a way that leverages the things that I'm best at? So leverage the core competencies and then be able to go ahead and do more, and that's where we see success.
That's great. So let me ask you, your working background is a little bit of TradFi. Now you're in the digital space. So are these corporate investors, are they prepared? Are they structured properly to get involved in this space?
Yeah, great question. So I would say to some degree, yes, but a lot, no. And I think it comes back to asking those questions. So for me, it's always just a matter of perspective, and I always want to sort of know, well, why is this actually happening? Why are we missing, sort of an opportunity? Why aren't we doing more? And I think, a good example maybe is just to take one of them is to look at allocations. Some people will do a passive allocation and get exposure to a digital asset like Bitcoin. And then you do it, and that's fine, but you can do more. So my question is sort of always, in the back of my mind, because I get so excited about active management, this is, what I used to do, and I used to be a market maker, and I think, why can't we do more? Is it because we don't know about how to connect properly via APIs? Are they missing a fixed component? Is there like a latency misconception that they don't think they're able to do the things that they could otherwise? And I think for a lot of the time is those questions aren't asked to be able to, again, leverage those core competencies.
Yeah, and I think another part of that too is it's my next question as well, because it comes up at, you and I spoke about it at the beginning of the week. It comes up at every conference I go to, every meeting I have is on regulation, right? So when you think about institutions, corporations, they already have regulatory oversight, compliance, risk committees, the whole 9 yards. Do you think they're agile enough right now for digital?
For sure. I mean, I'm on both sides of the fence. So I have a history in traditional and history in digital. So part of me will absolutely say that I think, yes, seeing what's capable and how things can be leveraged. I'm not saying that crypto isn't agile. Of course, crypto is agile, but there's so much that traditional players can do. It's kind of like, I love to use analogies and to think sort of in different ways. So I think the way, we can sort of think about it is because we are in New York. New York is known for having decent pizza. I'm from Chicago, so I'm not going to go ahead and say that we do it better. But I think we know a thing or two.
Sounds like a challenge, but we'll discuss that
sounds like
later.
a challenge. But the sort of point of that is pizza uses dough, pizza uses tomatoes, pizza uses some delicious cheese, and you make something incredible. And even though it uses those same ingredients, it looks a little bit different in New York, still tasty and delicious. And Chicago still does an okay job, right? And I think that's what really institutions can do if they just take that little bit of time to have that conversation. Because if you do that, then you understand how do I take these components to fill in what I need to do.
Right. So we've established that the traditional world can play with digital, hopefully nicely, and they will probably get married someday. But is crypto ready to function as an integrated system, as you mentioned?
Yeah, I really think very much so it is. It's not, it's not 2014, it's not 2015, 2016, it's not even 2018. We've made leaps and bounds in terms of strides of where we are now and what we're able to go ahead and do. So I think that functionality, when we were speaking to earlier about how excited I get about a fixed API and latency components and being able to build structured products. I mean, crypto is, for me, very much like an engine. Whether you want to put that engine into a boat, an airplane, something else, a car or motorcycle, you can go ahead and power many things with it. And I think when we've advanced so much, like I said, so you can use that capability and then structure all these sorts of things that really do aid and benefit to the way that institutions are used to working.
Yeah, the future definitely looks exciting in this space. So Sebastian, I just want to thank you for joining me today for Crypto.com Sponsor Spotlight and sharing your thoughts with us. I really appreciate it.
Super. Thank you.
Please welcome to the stage Pantera Capital CEO and Co-Chief Investment Officer Dan Moorhead with Bloomberg's Joe Weisenthal and Tracy Alloway in a live recording of Odd Lots.
Hello, I'm Joe Weisenthal.
And I'm Tracy Alloway.
We are the co-hosts of the Odd Lots podcast here at Bloomberg, and I'm psyched. We're going to be doing an episode of our podcast on stage with Dan Morehead, the CEO of Pantera Capital, which does VC and hedge fund type trading in the crypto blockchain universe. And we're just going to kick it off right away. So Dan, thank you so much for joining us.
Thanks.
All right, I have a question. I sort of ask it to everyone in the space. But, so far, what we've seen over the last year in particular is if you look at a chart of cryptocurrencies, Bitcoin, Ethereum, it looks like the NASDAQ or something like that. When's that going to change? Why are we even talking about crypto as a distinct asset class if right now it just seems to sort of trade as tech stocks?
Yeah, that's the $64 million question, right?
More than that.
So for the first 10 years of crypto's life, it traded with 0.08 correlation to the S&P. Then in some big sell-offs over the last 4 or 5 years, it traded with a little bit of correlation, but for only 2 months. This time has been very different. Admittedly, it does look like the NASDAQ. It's been correlated for 8 months or whatever. I think it's starting to break down. If you squint and look at the graphs, it is starting to break down. And that's the big trade, in my opinion, that I think risk assets are still going to struggle for some reasons we might want to talk about. But I could see a world where blockchain does really well, even if the other risk assets are impacted. And the main reason is most of the normal asset classes are really connected to interest rates, right? Bonds are mathematically connected to interest rates. Stocks are discounted cash flows. The PE upside down. The earnings yield is very similar to an interest rate. And then, real estate obviously is connected to mortgage rates, to discount rates as well. Whereas, Bitcoin is like digital gold, right? There's no interest rate component to it. It should be able to trade independently. And it hasn't for the last 6 or 8 months, but I think it really can for the next, period of time.
So maybe expand on that point a little bit, because when I think about crypto and Bitcoin in particular, I kind of think of it as the ultimate momentum asset, like driven almost purely by sentiment. So when you're in an environment when it feels like risk assets are falling apart, I can see why that kind of bleeds through into crypto and Bitcoin again specifically. What exactly is going to change in terms of investor behavior to make that different?
Yeah, so I'd say in these little short cycles, it does feel like it's a high beta version of the NASDAQ or whatever. But it's on a 20-year secular bull market. And that's what you have to keep in mind is that over the last 10 years, every 2 years, the number of people using Bitcoin or cryptocurrencies generally has gone up an order of magnitude. If that keeps going, we go from 200 million people using crypto today to, say, 1 billion in 2, 3, 4 years, the price probably goes up, right? And it really is Econ 101, supply and demand. So no matter what happens with the 10-year note or with the S&P 500, if 1 billion people are using crypto in 3 or 4 years, it will be a lot higher. And that's why I'm so bullish on it.
Okay, but then this also gets to another question of what do you mean by used? Because most people who I think have some exposure to crypto are almost certainly their exposure is through speculation, probably keeping it in some sort of centralized custodial account as opposed to actually using the chain in some manner. So when you say 1 billion people are going to use it, what do you mean specifically, or what use cases beyond hoping to get rich quick do you see taking off, making up that 1 billion?
Before I answer that, I want to give you one cool stat on this, Q3, the decoupling of crypto. So the S&P was down 4.9% in Q3. Bonds are down 8.2%. As Boaz just said, it's both are down when they're supposed to be anti-correlated. Gold down 7.9%. The Bloomberg Galaxy Crypto Index is up 16%. So it is starting to happen. And again, good news doesn't really...
What was the time frame of that?
Q3.
Okay.
Yeah, so good news doesn't really sell, but that is the good news. So it is starting to happen. And since the lows, Ethereum's up, 40%. A bunch of protocols are up a lot since the lows, whereas the S&P is still near the lows. So the question is it all speculation? It's not. There are some, people that do speculate in crypto, and admittedly, it's so revolutionary, it does get overhyped, right? And it's going to change the world overnight. It's going to, do things that is going to take 10 or 20 years to do. But the reality is, lots of people use crypto to store their wealth, to move money across borders. A good example is 10% of all U.S. to Mexico remittance goes over Bitcoin already. That is a great development for the world. The average remittance cost in the world is 8%. And for us in finance, that's just a number, right? 800 basis points. For the migrant, that's a month's wages. I mean, they spend an entire month working to pay the remittance company, and their family only gets 11 months of their wages. If you use Bitcoin or another cryptocurrency, you can send it to anybody on Earth with a smartphone. And that's why I'm so bullish, is there's 4 billion people that have a smartphone, and that's the only thing it takes to operate Bitcoin, right? And so, it'll take, 3 or 4 years to get to 1 billion, but I think it's pretty inevitable. And so that's why I'm so bullish. There's so many different use cases beyond just speculation.
All right.
So before Pantera, you worked at Tiger. You were also a bond trader at Goldman Sachs, I believe. So you have this extensive macro background. What was the transition like from macro to crypto? And are there parallels between being, a bond trader and being someone who's in crypto, primarily investing through venture capital and tokens and things like that?
It's actually very similar, and it's not a coincidence that a lot of the people in the crypto industry are kind of retread macro traders, because macro is all about looking for asymmetric trades around the world that are going to, have way more upside than downside. And over the decades, there's been things like Russian privatization or Argentine farmland or Tesla Motors or whatever, and those things are all really cool trades, really interesting, but they're just specific to either one region, or one asset class or whatever. And Bitcoin and blockchain are going to change so many different things, and literally for billions of people, and it's borderless. It operates in any country. So it's just the biggest trade in a generation. I think it's kind of the second half of the internet. So it's kind of equal in its importance to the other protocols that made the internet work. And the reason to be involved in it is it's just going to disrupt so many different things that even if we're wrong on like a couple of them and those don't work, it's got so many other use cases that it is a really strong macro style trade. And again, macro was kind of dead for a while. Rates were at zero everywhere, and kind of nothing interesting on the policy front happened.
Right. I remember people complaining about the lack of volatility in the markets, and here it is.
In
and
retrospect, we shouldn't have complained so much.
Yeah.
That was those were the good times.
Yeah, no, macro's back, right? Like there are so many crazy things. Like the Bank of England, it's tightening and easing at the same time. That's wild, right? Like so, there's a lot of kind of tectonic shifts that are happening here, and that's where great opportunities come. Things are actually really moving.
I want to ask another question about correlation that I think about a lot. Okay, we talked about cryptos or Bitcoin's correlation to the NASDAQ. Intra-crypto correlation. If you look at a chart of Bitcoin and Ethereum, culturally it's sort of like, there are all kinds of reasons they've become very different assets. At least it seems to me. And one, digital gold, the other one's sort of this platform for distributed computing, all kinds of differences. Yet even those charts basically look the same. When are we going to see sort of more discrimination, perhaps, within crypto so that, I don't look at a page and it's all green and it's all red one day? It still seems like everything is just beta to Bitcoin or beta to Ethereum.
It seems like that, but if you actually look at the numbers, it isn't, right?
Okay.
So Bitcoin is very close to its low of June 18th, but Ethereum's up 42%. Uniswap's up 90% since the lows.
That's not just the sort of crypto beta, like general.
They're positively correlated, right? Like I'm not saying that some are going to go way down, some way up, but with Bitcoin not doing much over the last 4 months, some of the other protocols are really ripping. And I guess the important thing to stress for investors is there was a time that Bitcoin was everything, and all you had to do was put your money in Bitcoin, and that was it. And then there was a time you kind of put half in Bitcoin, half in Ethereum, and you were fine, right? Now a huge amount of the kind of the value creation is coming in other projects, and it's not surprising. It's like there wasn't one company that became the internet, right? There's a lot of important internet companies, so there will be quite a number of important protocols.
I want to go back to the use case question because I believe you started your interest in crypto in 2013, which is relatively early.
Super early.
Yeah, I started writing about Bitcoin in the same year. And I remember people being excited about blockchain technologies. This was going to change the world. And, a little less than a decade on, it feels like we're still sometimes talking about hypotheticals. So inroads have been made. But certainly when it comes to blockchain tech, DeFi, the whole Web3 idea, it's still sort of a thing that's on the horizon. So A, if the technology is this revolutionary, why isn't adoption happening faster? And then B, how do you actually evaluate these various projects and tokens, given that often the use case is, far off into the future?
Yeah, so there's a lot of people that are negative about crypto, and it's kind of like in the 90s sitting there with the 8K baud modem in your bedroom screeching, going, the internet sucks. It did suck in the early 90s, but now they built out a lot of really cool stuff, and the internet's important. So that's the way to think about crypto, is it does some things really well. It's really good for storing your wealth. It's really good for moving money across borders. So there's already, tens of millions of migrants that are using Bitcoin. But some of the, like property titles on the blockchain haven't happened, those kinds of things. Doesn't mean they won't happen. And so that's the perspective, is that each of these things will happen sequentially. And I'm pretty amazed. There's 200 million people using blockchain, right? That's a pretty big thing. So each of these use cases is getting rolled out in its own time. And there are certain things, like someday all of Wall Street's back office is going to be on a blockchain, right? But that's going to take like 20 years because it's very complicated.
Some of them are still using COBOL and
exactly,
stuff invented from the 1950s.
No. I saw there was a huge boom in COBOL engineers, trying to.
Why is that? Because I mean, one of the things about distributed ledger technology, blockchain, whatever you want to call it, the way I think about it, and tell me if I'm wrong, is that there's a certain you pay because it's distributed. There's a certain increased computational cost, but because the advantage is that maybe it's censorship resistant, it's permission free. Why do you anticipate that cost will be worth it for Wall Street banks, such that all of finance will be on a chain?
Oh, I'm saying that's a 10 or 20 year thing.
No, but even in 10 or 20 years, like, why is that a superior architecture for finance than the sort of ultra fast, ultra cheap centralized databases?
Well, because there's like 1,000 different databases that have to be reconciled all the time. So if you had a one blockchain solution, you'd have a timestamp thing where all the data resides in one spot. But that is way down the road. The thing that's actually happening now is Web3. I think that's a great concept. That we're used to all these internet companies doing cool things like sharing music, social networking, all that stuff. But they're really expensive. They suck an enormous amount of the value out of the equation, and the contributors often get very little, or in social networks, zero, for people that contribute all the value. And Web3, I think, is one of the most inevitable trades I've ever seen. We might be early, it might take longer than we're thinking, but having decentralized versions of all the companies we're used to, like Airbnb or Spotify, having a decentralized version is way better. You're right, it's a little more expensive maybe to maintain data on a blockchain, but you're not paying the 20 or 30% rent that the equity-owned companies are doing. And you're already seeing use cases like music sharing. Audius is a project we've been invested in. It's connecting artists directly with the consumers, which is way better than having some entity taking 20 or 30% out of the middle. And then the really cool thing is the people that are engaged and contributing to the network. The kid that's on his phone finding new bands and upvoting them gets paid a little bit of the network's value. And so the more you contribute, either as a recording artist or even as a fan, you get to own a chunk of the network. There's already 8 million active users, so it really is taking off. And the other benefit of Web3 is not just being cooperatively owned, it's ultimately being cooperatively governed. And there's some governance issues with some of the big entities out there. And so having the community itself, decide how to, who can use it, how they can use it, ultimately I think this would be way better than our centrally controlled Web 2 companies.
So this actually leads into something I wanted to ask you, but if you are a crypto investor, which you clearly are, you can invest in the space in different ways. So you can buy equity in a crypto startup, or you could buy the token, which might come with some sort of use benefit or governance participation through a DAO or something like that. How do you evaluate the way in which you gain exposure to these different projects?
Yeah, so that's a super important point, is that when the internet came around, you couldn't buy a chunk of TCP/IP or other protocols. The only way to get exposure was buying equity like pets.com or whatever. So here you can do that. You can invest in venture equity, but you can also buy a chunk of the protocol. And so I think it's really important, and for our advice to investors is to have some exposure to the protocols themselves and some exposure to venture equity. The protocols have generated most of the value. So Bitcoin, Ethereum have way more value than the sum of all the equity companies in the space. But they have different characteristics. So I think a great portfolio is some of both. And then the specific question is now, like back in the day, things were either a token or equity. Like Bitcoin was just a token, it was never going to have equity. And then things that were venture startups would rarely have tokens. Now there's a lot of projects that have both, and admittedly, it's hard to tell sometimes where the value is going to accrue. And so the industry typically, and we do as well, typically buys both in a project, so that if 10 years from now we found out that most of the value went to the token, that's fine, or to the equity, it's fine.
Do you see several layer one chains?
Yeah, so that's a great question.
What does the future look like?
Yeah, I think so. And there's a lot of religious people out there that want it to be just one. Well, there's lots of different use cases, and it's kind of like, again, going to the internet analog. There isn't just one internet company. There's a bunch of different things, and there's a bunch of different companies. And so the same thing here is there are different attributes that people want in layer ones. We mentioned digital gold, Bitcoin. It's really good at storing wealth. It's really good at moving money across borders. It doesn't do other things, right? That's its virtue or its vice, whichever perspective you have on that. And Ethereum's really good at smart contracts, but its throughput isn't that great. And so if you're going to store an enormous amount of money, you probably want to store it on Bitcoin. If you just want to play video games and don't really care about security, you might want to use Solana, right? So I think there's going to be something like 10 important layer ones in the long run, each doing their own thing. And again, that's like the internet. It's easy to see a world with 10 or so. The one thing I would say is it's not going to be like 5,000. And so there will be a kind of single digit number of layer ones.
So we are going through a crypto winter, which is kind of an expression I hate, but a crypto bear market at the moment. What advice do you have for investors, many of whom would have probably bought at the top and are now facing losses? Oh, and also, sorry, can I just tack on to that? What's it like actually fundraising for blockchain-related projects in that environment? Because you are raising money at the moment for a big new fund.
Yeah, so human nature is very pro-cyclical. Everybody wants to buy at the top, and not that many people want to buy at the bottom. And we've been doing this for 10 years. This is our third massive bear market in those 10 years. And yeah, inflows were booming in February, March, and they kind of have dried up right now. So the advice would be buy low, sell high. And
you make it sound easy.
It's just so hard because when it's at an all-time high and everybody's on TV talking about Bitcoin, the FOMO devil's whispering in your ear is really easy to want to buy. And then coming home to tell your spouse you want to put a lot of money into Bitcoin today doesn't sound very fun, right? So, but it is probably a great time because all the fundamentals are happening. The Fed's building a blockchain. China has 200 million people using a blockchain. The oldest bank in the United States, Alexander Hamilton, built Bank of New York, and he's selling Bitcoins now, right? They're storing Bitcoins now. So, things really, all the fundamentals are great. It's just it got caught up in the risk reduction. And I would say one of the reasons why crypto's price looks kind of like the NASDAQ is there was excessive leverage in our industry. There were some centralized finance companies that, just old school banks just borrowed too much, lent to things that didn't work, and got liquidated. And I think, unfortunately, that kind of caught up crypto and made it look like it was more connected to the NASDAQ than it really should be. It was really just over leveraged in our system. And the important point to make there is there's kind of a narrative out there that DeFi failed, like it didn't work. DeFi worked great, like Aave, Compound, all those things, process transactions 24/7 without anything ever going wrong. It was centralized finance protocols. There's the companies that ultimately, didn't work.
So this actually leads nicely to a question we have from the audience, and do keep sending those in. So someone asks, are the nonstop new coins being developed helping or hurting the industry? And I'm just going to rephrase that slightly, but you mentioned some of the froth going out of the market over the past year. Like, is that all gone? Are we in a healthier place now, or is there still another shoe to drop given the volatility that we've seen in traditional assets and what's going on with interest rates?
Yeah, it's a great question, and the distinction I would make is most of these aren't new coins, and so people, they're not layer ones or blockchains themselves or cryptocurrencies. And one thing that sometimes people get wrong is to say, hey, we don't need 5,000 new currencies, and that's been said in the official sector here in the U.S. The loss is that we only need about 10. There's about 10 blockchains that we need. But most of the projects that we're excited about are really just applications, like digital companies that are built on top of Ethereum or Solana. They're like companies that are being built on top of other applications. And we have 4,500 public companies in America, right? We could easily have 4,500, tokens. So I don't think there's any kind of problem with the number. Yeah, in the bull markets, more money gets raised to projects that probably don't make a ton of sense. And so these times are better because very few projects actually get funded, and most of those are really good. And we saw, we closed our last, or invested our last venture fund in 2018 and 19, right, in the last crypto winter. And that was awesome. All those investments did incredibly well. So I think over the next couple of years, it's probably a great time to invest.
So speaking of use cases and so forth, there's a poll that is flashing up there. So if you scan your phone on the QR code, you can vote on areas of crypto do you find most compelling. But I want to ask you, you said, you likened the new projects that you're investing in to the 4,500 listed companies. Are they companies, and are tokens securities, and should they be treated by regulators as such?
Loaded question.
No, it's a key question. But
so it is a good question. They are like digital companies, but they have a lot of different characteristics, like collective cooperative governance and all those things. And I am absolutely not going to do a Howey test rundown, here, because it is. I admit it's very hard to apply 1930s regulatory frameworks to unbelievably wild new technologies like DLT, right? So it is difficult. I know there is a case pending with Ripple and the SEC, so we'll find out at least if one's a security or not soon. But it's tricky to try and say whether these incredibly new technologies are either in or out of some 1930s regulatory frameworks.
What would you like to see ideally from regulators? How should they approach the space? I mean, again, considering that they have a mandate for financial stability or for consumer protection, so they do have to put some oversight on the space. But what would you ideally have them do?
Yeah, so first I'd say that at least in the United States, the glass is 7/8 full, right? Like 7 out of the 8 bodies have already ruled, and ruled great. The IRS ruled in 2013 that crypto is not a currency, it's property, so you get long-term capital gains tax treatment. The CFTC has been incredibly progressive, been engaged in crypto since 2013, their futures in 2017. So most of the regulatory bodies have ruled. And so really it's the SEC in the United States that's left. I would say that clarity would be very helpful for our industry, that most players really want to execute business in a way that is acceptable. And so if there were more clarity, I think that would be good for our industry. And then globally, there are a handful of countries that have been very progressive in trying to foster development of, I think, it's a massive future industry. So it'd be great to have that industry develop in the United States. And that is actually a big distinction. The U.S. literally built the internet with DARPANET, and then gave incredible benefits to internet companies, right? They exempted Amazon from 8.25% sales tax for a long time, and they gave them a huge advantage over the bricks and mortar store right next to everybody. And so all the big internet companies ended up in the United States. As a U.S. citizen, I think that's great. I would love to see that in crypto. The reality is the regulatory regime is scary, and 19 out of the top 20 protocols reside outside the United States now. And the last one's the one that's in a lawsuit with the SEC. So, it'd be great to keep it onshore. And the important point for regulators is whether they like blockchain or not, it's happening. And you're not going to get the toothpaste back in the tube. So it'd be better to have it, onshore rather than offshore.
So I want to ask a question, and I think it kind of dovetails with the question of, are there too many coins? But it has to do with incentives, because one thing that I think about crypto is that a lot of people have made an extraordinary amount of money, and in many cases without having created the killer app or created a ton of consumer value. And it seems also like in many cases there are opportunities to make a fortune in a very short period of time without necessarily having the project play out. Is that the case, or is my perception off? And would it be better if there was some sort of restructuring of incentives that it would encourage more sort of long-term creation building, or payoffs that were further down the road after some sort of a clear consumer surplus or use case had been demonstrated?
Well, I think the reality is most projects, there's been 5,000 things launched over the years, and most haven't worked and have been bad for speculation. So it's not like, hey, everything just goes up. And so, so the good projects do get funded and ultimately do have traction and have, lots of people using them. And there is value, and it kind of is creative destruction. Like the internet, a lot of projects didn't work, but the ones that persisted have a ton of value.
I want to go back to the macro environment in general, and I have a good segue into this, which is I was trying to chart the volatility of some long-dated UK inflation-linked gilts yesterday versus Bitcoin. The linkers are much more volatile than crypto now, which probably says more about the environment for bonds and duration and what's going on with the BOE than it does about Bitcoin, but still kind of interesting. How long is this environment going to go on for? Is there a bottom in sight for traditional assets such as stocks and bonds?
So that is an important question. I think it's a lot longer from now than most people think. And I know that's hard to hear, but we had a 42-year bull market in rates that bailed out everything else, right? Stocks, real estate, everything's been going up. Rates started rallying in 1982. And I think we're just used to, well, any boo-boo that the stock market has or, the housing market has, well, the Fed will just cut rates and that'll fix it. And it fixed a lot of things for a long time. Rates got to zero, potentially for too long. And now there's just unfortunately a lot of unwinding that has to happen. So I wish this weren't true, but my professional opinion, I think, is that bonds and risk assets probably struggle for a period longer than a couple days, which is what most of us hope for.
Well, you mentioned, and an audience member is asking about bringing money back into DeFi space specifically. But you mentioned that there's there's cryptocurrencies that are very different than equities or traditional risk assets, but some kind of do see the same, and you have like a certain level of like cash flow or implied cash flow in a lot of these. So, what will bring these sort of areas of crypto that kind of resemble stocks or kind of resemble bonds or traditional finance? Will they struggle as long as risk assets do? Or is there some other catalyst that would say bring money into the DeFi space, even if bonds and stocks, et cetera, continue to struggle?
Yeah, I think the story is that, we're on this long secular thing, pulling potentially billions of people into crypto, and that kind of bails out all the little cyclical issues. And a way to think about it is fun new things like NFTs and gaming are now bringing enormous amounts of people into the blockchain space, and that just creates more demand, more people using it. And again, if I'm right in that 3-4 years from now, 1 billion people are using blockchain, it probably has to be higher, no matter what happened to the S&P. If you're having that many people buy something, there's a fixed quantity of, right? There's 21 million shares.
You're always making new monkey pictures, though, right? Or NFTs.
Yeah.
Okay.
If the Fed were to pivot, within the next year or something, and interest rates start to go down, would that be good or bad for crypto, given that ostensibly you do want to see it start to decouple from rates?
No, it would definitely be good. I remember vividly in March of 2020 when the pandemic policy response was starting to happen, we sent out our investor letter super bullish on crypto because printing all that money had to be incredibly positive for anything with a fixed quantity. It was going to be great for real estate. It was going to be great for Bitcoin, whatever. So if the Fed did pivot and went the other way from where I think they're going to go, it is definitely very good for crypto. My only point would be, even if they keep hiking, I think crypto can still do well. Because investors have to put money somewhere, right? And most institutions are kind of triaging their portfolio right now, trying to figure out what just happened. Obviously, a big paradigm shift happened, and trying to figure out, how much damage to their various portfolios. But when they actually start thinking about where to put money to work, and they look at, rates are rising, and I think they're going to rise quite a bit more, so that'll hurt equities. Blockchain can trade independently, and with a lot of projects already up 40 or 50% since the lows, it's starting to show a little bit of promise for where people could put money to work and be safe.
Dan Moorhead, CEO of Pantera Capital, thank you so much for joining us in this live episode of the Outlaws podcast.
Thank you. Thank you all.
Grayscale Investments is the world's largest digital currency asset manager. We pioneered and have been the catalyst that has gotten many investors involved in digital currency related investments. As we think about the future, we're really excited to continue to expand our product family to ensure that we're always not only meeting investor demands, but actually creating demand that investors need in their portfolios.
Please welcome to the stage Grayscale Chief Financial Officer Edward McGee with Bloomberg's Emily Gallagher.
All right, this work?
Hello, everyone. I'm Emily Gallagher. I am our Global Head of FX and Commodity Product here at Bloomberg LP, and I'm pleased to be joined by Edward McGee, who is Grayscale's Chief Financial Officer. So, Ed, why don't we just get started for the Grayscale Sponsor Spotlight? We're going to talk about the evolution of cryptos for institutional adoption. So I guess my first question for you is, you came from a traditional financial background. We were talking a lot about that in the green room. Tell me why cryptos and what has changed since you've been at Grayscale?
Yeah, well, one, thank you for having me. Thank you for having us. This is a phenomenal event here. When I left traditional finance, I was leaving Goldman Sachs in 2019, and it really became a question of why not crypto? At that point, I was spending a lot of my personal time researching the asset class. I think that my path followed a lot of what traditional finance professionals have noticed who've decided to jump into the space, which is there's an awareness of this asset. You kind of know that it exists on the periphery. And then there's an intrigue, and you start to do some research, and that turns into an adoption. And the adoption of the asset class for me was not only personal, but professional, where I said, I want to go be engaged with this technological, not revolution, but the capabilities of the technology. And I found Grayscale as a great home to go pursue that. And I was fortunate enough to be given a seat where Grayscale, as the world's largest Bitcoin trust, or the asset manager of the world's largest Bitcoin trust, kind of sat at this crossroads of traditional finance and crypto, and so that's when I kind of jumped into it.
Yeah. And what are some of the trends and developments that you feel like are things you're thinking about right now? What's top of mind?
Yeah. Well, what's top of mind is. Maybe I'll start with what's not top of mind, which is, momentum on price. And what is top of mind is what I've seen is not a retreat by institutions in building technology that can really report back to institutions for either their clients or themselves where this asset fits in their portfolio. So we have research out there called the Modern Economic Portfolio, or the Modern Portfolio, and it walks through how crypto might present itself as a sleeve within that broader suite. But from a technology perspective, from an institution risk management perspective, that asset has sit separate from equities and fixed income products. And there's been a really nice uptick from a technological perspective to say, how do we view this portfolio holistically? How do we develop technology to take in where these assets are from a custody perspective or a trading perspective? And how do we view and risk manage that portfolio more holistically?
And what do you expect for us to see next coming out of Grayscale?
Well, Grayscale, like myself, has kind of walked through an evolution of its product suite. And so we have 17 digital asset products. 14 of those are single asset products that are wrapped in a grantor trust. But we've also developed thematic products with multiple assets now sitting in these products. And that's really a reflection of how investors have taken a leap forward in how they think about the asset class, how they describe narratives and the technology. And it's not just Bitcoin, it's not just Ethereum. There's actually use cases that are being being defined in a different way, and we offer those themes. We also offer now this a second layer from like an infrastructure play perspective. Investors and ourselves view not only passive exposure as an opportunity, but the infrastructure of digital assets. And so we've just recently launched a vehicle that would allow investors to co-invest alongside us called GDIO, or the Grayscale Digital Infrastructure Opportunities product. And we're really excited about where that could go, where it's not just passive single token or multi-asset exposure, but really getting into the guts of how digital assets work and how the infrastructure that is necessary is a business in and of itself that can be profitable.
That's great. That sounds really exciting. We are sitting between the break for this group. So thank you so much for joining me today, Edward, and discussing the evolution of crypto for institutional adoption. We are going to take a break, so stretch your legs and get a beverage, connect with your colleagues. We are going to be back here at 2:50 sharp. So we'll see you then. Thanks. Thank you.
Standing in the cold and the frozen wind, I'm leaving you behind, but it's not the end. No, no, no. Walking on a plane as I hold my breath, it's gonna be weeks till I breathe again. No, no, no. I know that you hate it, and I hate it just as much as you. But if you can brave it, I can brave it all for you. Call me anytime you can see the lightning. Don't you be alone, you can always find me. We got a wild love raging, raging. Lost among a million changing faces. Every day our hearts keep trading places. We got a wild love raging, raging. Checking into hotel loneliness, it's not what I've been used to, I confess. So wake up 3 times a night. Talking to a stranger is nothing new. She knows how to smile but not like you. So I wait for you all night. I know that you hate it, and I hate it just as much as you. But if you can brave it, I can brave it all for you. Call me anytime you can see the lightning. Don't you feel alone, you can always find me. We got a wild love raging. Lost among a million changing faces. Every day our hearts keep trading places. We got a wild love raging. friends are heathens, take it slow. Wait for them to ask you who you know. Please don't make any sudden moves. You don't know the half of the abuse. All my friends are heathens, take it slow. Wait for them to ask you who you know. Please don't make any sudden moves. You don't know the half of the abuse. Welcome to the room of people who have rooms of people that they love one day docked away. Just because we check the guns at the door doesn't mean our brains will change from hand grenades. You laughing on the psychopath sitting next to you. You laughing on the murderer sitting next to you. You think I'd get here sitting next to you. But after all I've said, please don't forget. All my friends are heathens, take it slow. Wait for them to ask you who you know. Please don't make any sudden moves. You don't know the half of the abuse. We don't deal with outsiders very well. They say newcomers have a certain smell. Yeah, trust issues not to mention. They say they can smell your intentions. You laughing on the freak show sitting next to you. You laugh some weird people sitting next to you. You think I did not get here sitting next to you. But after all I've said, please don't forget. All my friends are heathens, take it slow. Wait for them to ask you who you know. Please don't make any sudden moves. You don't know the half of the abuse. Why'd you come? You knew you should have stayed. I tried to warn you just to stay away. And now they're outside ready to buzz. It looks like you might be one of us.
Darling, darling, I'll turn the lights back on now. Watching, watching, as the credits all roll down. And crying, crying, you know we're playing to a full house. No heroes, villains, one to blame. While wilted roses fill the stage, and the thrill is gone. Our debut was a masterpiece, but in the end, for you and me on this show, it can't go on. We used to have it all, but now's our curtain call. So hold for the applause. Oh, 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 oh. And wave out to the crowd and take our final bow. Oh, it's our time to go, but at least we stole the show. 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 are sold out. This is fading, but the band plays on now. We're crying, crying. So let the velvet roll down, down. No heroes, villains, one to blame. While wilted roses fill the stage, and the thrill is gone. Our debut was a masterpiece. Our lines we read so perfectly, but the show, it can't go on. We used to have it all, but now's our curtain call. So hold for the applause. Oh, 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 oh. And wave out to the crowd and take our final bow. Oh, it's our time to go, but at least we stole the show. At least we stole the show. At least we stole the show. At least we stole the show.
was doing just fine before I met you. I drink too much and that's an issue, but I'm okay. Hey, you tell your friends it was nice to meet them, but I hope I never see them again.
Please take your seats. Our program will begin in 10 minutes.
4 years, no calls. Now you're looking pretty in a hotel bar, and I can't stop. No, I can't stop. So baby, pull me closer in the backseat of your Rover that I know you can't afford. Bite that tattoo on your shoulder. Pull the sheets right off the corner of the mattress that you stole from your roommate back in Boulder. We ain't ever getting older. We ain't ever getting older. We ain't ever getting older.
Look as good as the day I met you. I forget just why I left you. I was insane. Stay and play that Blink 182 song that we beat to death in Tucson. Okay. I know it breaks your heart. I moved to the city and I broke down crying. 4 years, no call. Now I'm looking pretty in a hotel bar, and I can't stop. No, I can't stop.
So baby, pull me closer in the backseat of your Rover that I know you can't afford. Bite that tattoo on your shoulder. Pull the sheets right off the corner of the mattress that you stole from your roommate back in Boulder. We ain't never getting older. We ain't never getting older. We ain't never getting older. So baby, pull me closer in the backseat of your Rover that I know you can't afford. Bite that tattoo on your shoulder. Pull the sheets right off the corner of that mattress that you stole from your roommate back in Boulder. We ain't never getting older. 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 We ain't never getting older.
Please take your seats. The program will begin in 5 minutes. Please take your seats. The program will begin in 5 minutes. Please take your seats. The program is about to begin. Please welcome to the stage Graham Capital Management founder and chairman Kenneth Tropin with Bloomberg's Eric Schatzker.
This is Ken. I'm Eric. We're going to talk about macro, right?
Hey, Eric. How are you?
I'm well. It's great to have you here.
Thank you for having me.
I'm going to tell you first a little bit about Ken's firm, Graham Capital. You may not know it. It's got about $19 billion in assets, $12 billion of which are in quantitative strategies, $7 billion of which are under discretionary management. It is a macro firm.
Correct.
It has, folks, been an extraordinary year for macro. Some managers, as you may know, are up 200% or more. Ken, I know SEC rules prevent you from talking about Graham's returns, but they don't prevent me from talking about Graham's returns. And as I understand it, your funds are up between 20 and 50% roughly. And on the upper end, again, as many of you may know, that's better than Bridgewater, and it's better than Citadel. You've been in the investing business for 40 years.
Yes.
How does the macro environment today compare with everything else you've seen? And I know and am familiar with a few of those episodes, at least going back to the 90s. We're talking about the peso crisis. We're talking about the Asian currency crisis. We're talking about the Russian debt default. We're talking about the dot-com crash. We're talking about the great financial crisis, the European sovereign debt crisis, the pandemic. The list goes on. How does it compare?
Well, what I would say first and foremost is markets are moving, right? If you look at what drives macro performance and opportunities, it's how much central bank movement there is, really. Central bank movement is going to equate to FX volatility. It's very often going to equate to equity volatility. And so what's happening today that's really interesting is central banks are moving rates, and they're moving them a lot. And that's in stark contrast to what was happening in the previous decade, where it was very, very quiet. And so from a very big picture point of view, and here's kind of an interesting number. If you look at the period from, say, 2010 to 2021, and you look at the ECB, and you look at the Bank of England, and you look at the Fed, in that 11-year period, there were a total of 13 25 basis point equivalent hikes.
Among
all
three
major central banks. This year, there have been 26 hikes alone, and we're pricing in 44 hikes of 25 basis points a year between those three banks. So the opportunity set is obviously exponentially more interesting.
And it is just as simple as that. It is a richer, more fertile environment because central banks are raising rates.
Well, and there's divergence, right? I mean, for example, Japan's not raising rates. They're holding their upper band at 25 basis points. We're not sure that's going to last forever, right? The dollar yen's at 146 or something today. You know, if they were to release that band, there'd be a lot of opportunity on the downside in dollar yen, whereas so far this year it's been pretty good to us being long dollar yen. But you have a very divergent set of circumstances in Europe compared to the U.S., compared to Japan, and so on. And so that's just good for macro trading.
So going back to your first days on Wall Street at Shearson.
Yep, Shearson. And
then you went to Dean Witter. Is this the best macro environment you've ever seen?
Well, it's up there. I mean, it was really, really good in the 80s and 90s because if you think about it, markets were less efficient then. And so when markets are inefficient, there's a lot more to do. And there tend to be overshoots and different, market momentum events and all of this kind of thing. And as the markets got so efficient in the previous decade, and you had inflation essentially close to zero, right? There's not as much to work with. But I think, it's going to get interesting. It's going to be interesting for macro for a few years.
A few years?
Correct.
So that may be of interest to some people, perhaps even people here, because macro became an unpopular strategy. It wasn't doing particularly well on the whole in that sort of post-GFC decade. And people allocated to different strategies that were generating better returns. And they may have missed out on the numbers that I was talking about just a few minutes ago.
Yeah, the way I think about it, and I think about the history of the hedge fund industry, and most of the early hedge funds were macro funds. Not all of them, but many of them were. And people looked to us to provide a source of returns or source of alpha that was completely uncorrelated to the other things they had in their portfolio. And, I would say our investors had the luxury in the previous decade of being very heavily weighted towards beta, and you got rewarded for that. It was as benign an environment for beta as you could possibly want, with inflation close to zero and central bank policy on hold. Now the opposite is true. And so I think if macro wasn't so interesting in the previous decade, it's also important to note that we generally generated positive returns, so it didn't cost you money to be more diversified. And when you need that diversity in a year like this, we're providing it, and we didn't cost our clients money to be allocated to us historically. So, yeah, there's a lot more to do in macro now, but there's been a lot of periods in the last 20 years that have been pretty exciting for macro.
You were, Ken, months ahead of the market anyway in concluding that inflation was going to be sticky and require more monetary tightening than most investors at the time anticipated. Is inflation still the dominant theme in the macro narrative?
It's right up there. I mean, I think we've heard from Powell how concerned they are about inflation. And, rightfully so. If you go back to the Volcker era, it was really, really tricky to get rid of inflation. It took a very, very long time. It did not happen in 2 years. And if I recall correctly, the central bank started easing because they thought they had it under control, and then they had to raise rates again. I think, peaking at extraordinary high levels by today's standards. So I think inflation and some of the factors that cause inflation are not so easy for the Fed to manage. Some of them are out of their purview. The supply chain disruption. The Fed really can't manage that, right? And so the Fed really can't manage what energy prices are. So I think the Fed has got their hands full, and I think the market's expecting the Fed to be able to start easing at the end of 2023. I'm skeptical.
You are.
I am. I think inflation will come down for sure, next year, but I don't think we're getting anywhere close to target of 2%. I think it may be 2025 before we get to target, if then.
As I'm sure you know, the great debate at this very moment is about overshooting. You know, does Jay Powell's Fed hike too much too fast and wreck the economy in the process because it has to regain the credibility that it lost, calling inflation transitory? And we might describe that as the Jeremy Siegel camp, because he seems to have become the most exercised about it. And for those who don't know, he's the Wharton professor of great repute. On the other side of the debate, which we could call the Larry Summers camp, right, is that the Fed must re-anchor inflation expectations at all cost. Which camp are you in?
The latter. The latter. You know, I just think that inflation's so poisonous if it's not managed successfully. So I think we want to err on the side of getting it comfortably down to target. It's going to be painful for the economy. Powell's conceded that. I think that's another way of saying we're going to have a recession. When is kind of the key question, and for how long. But I think it's one of those things that we just have to accept after years and years and years of easy monetary policy. Ultimately, you know, the inflation genie got out of the bag. It's hard to put it back in. It's kind of like an ocean liner. It takes a while for it to turn around.
So much of what you do is analyzing the economy and trying to anticipate what data will be. But the other half, at the very least of what you do, and maybe it's more than half, is trying to figure out how central banks will respond to the data as they come out. And that, to me anyway, goes back to what you were saying about divergences. Where do you see divergences opening up and widening, perhaps, between the major central banks of this world?
Right now, the most stark example is Japan versus, say, the U.S., right? And, you know, Kuroda's term is up, I think, in April of 23. So that's going to be an important catalyst to watch. Do they loosen that band if dollar yen goes to 160 or something from 146? You know, does that provoke a reaction function? They intervened in the currency markets very recently, so it tells us they're not happy with that. You know, you've got inflation in the Netherlands. I believe it's 15%. You've got the cost of power in Europe, you know, depending on what forward contracts you look up, you know, hundreds of percent higher than the previous year. So they have a very dramatic inflation problem that's very supply side driven over there. The inflation problem in the United States is partially supply side driven, but partially driven by higher labor. And, you know, you think about so many employees in the United States. I have 180 at my firm. I have some number that are 35 and younger. They've never experienced a recession. And so it's going to take a while for the psychology of the employee to say, you know what, if I'm out of work, that's not great. I really don't want to lose my job. I want to, you know, keep working and so on and so forth. I think there is a complacency that has developed in the workforce where the expectation about constantly higher compensation and so on, and firms competing for precious few employees have been, you know, contributing to inflation. That trend will reverse. It won't reverse quickly.
I'm curious, because you brought it up, how do you teach people who have never lived through a recession, right, who didn't have a seat, so to speak, during the great financial crisis, how to invest at a time like this? And furthermore, I'd have to imagine that besides you, there's almost nobody at Graham who was working when Paul Volcker pulled the Saturday Night Special.
Well, we do have a couple of other fairly experienced people, but look, I think that the experience of going through a recession is something that you can't teach, you know, a person. You have to sort of go through it. You have to see the effect on your peers and what have you. Maybe it's a little bit generational. I don't know. But you know, the bigger point is that I think we're going to come out of this fine and better off for it. It's just a reality check of having a straight shot up in equity prices for 12 years. And now we're getting a more normal market where, they go up, they go down, and we may be in a trading range for equities for some number of years. And that, that's not so abnormal.
Just as a matter of principle, I think people might be interested to know, do you believe, let's just take your investor's hat off for a moment, do you believe in price stability? Do you think the inflation target should be 2%, or do you think it should maybe run hotter for a while?
Well, I think it will be hotter for a while. I think I don't disagree with the goal of having 2% inflation. We saw how good that was for the economy, that we saw that good was for asset prices and risk assets for a very long time. So I think that's a very worthy goal. I just think it's not realistic to expect that to always be the case.
Given the picture you've painted, Ken, what do you figure the peak yield on the 10-year Treasury is going to be?
Well, that's a very good question. So the market right now for the 2-year is sort of pricing in 4.3 now, 4.75 at year end. And then I think we start to see that ease back down in the middle of 23 to maybe 4.25, something like that. And 10-year notes right now are 3.95. And
they haven't yet crossed 4.
And they have not, well, they haven't stayed above 4,
That's
right?
Yes.
And so I think there's a mispricing there personally. I don't, for all of the years I've been in finance, most of them, there was something called duration risk for being in longer dated bonds. And that's completely missing at the moment. And if you think inflation's going to be around for not just this year, but maybe 3 or 4 or 5 years, and, then bonds look a lot less attractive when you have to get out 10 and 15 and 20-year maturities. So I think there's the yield curve, which is slightly inverted, will probably at some point
re-steepen.
It should get steeper.
And mispriced means a 3.95 10-year should be what instead?
50, 100 basis points higher?
Really? That's meaningfully higher.
Yeah. Well, I mean, think where we've come, right? I mean, rates have moved a lot, but they needed to, and I think they'll keep moving. So yeah, I think there's plenty of opportunity there.
Your firm trades Forex, cash bonds, interest rate futures and swaps, equity indices, some single names, credit, commodities, anything else?
Mortgages, but I would say the majority of what we do is in very liquid markets because we like the idea if as a risk committee, which we meet every day and have, we talked about that, we want to be able to exit positions without a great deal of expense. And that's of paramount, importance to me, having been through some challenging market environments in my time. I want to always be the guy who gets out of the market sooner than later, not later, at great expense.
Which of your trades is working best right now?
Well, this year, if I put it that way, it's been a great year to trade foreign exchange. There's been a huge move in dollar-euro. Dollar-euro was 120. Now it's, 97 or something.
Dollar-pound.
Sterling has been a really good opportunity for us. Dollar-yen's moved a lot higher this year. We've done reasonably well in energy. It's been of the commodity sector, that's been the most profitable for us, which would make sense. And in fixed income, we've done quite well, being short bonds of various durations and various different geographies.
The dollar has been a profitable trade. It's a crowded trade, too. Do you think it has more room to run?
Yeah, it's definitely expensive. And I think the path of least resistance is the dollar goes a little higher. But we're pretty cautious here. We're pretty light compared to where we might have been. I think it's important to emphasize that Graham, particularly on the discretionary side of our business, is very tactical. We can be long a market today and within a few days have the other side. So we're perfectly willing to stay open-minded and move according to the changing, price data, information, and so on. And we try not to be too stubborn about that. Our quantitative systems are somewhat longer term in nature. They would tend to move around, say, over a period of weeks and months, whereas our discretionary traders, they move very quickly.
There are a lot of people interested in the British pound. You mentioned sterling having been good for you. I think it bottomed a couple of weeks ago at 103.50
right,
or thereabouts. Is that a floor, do you think, or could it weaken further?
You know, again, I think it's already made a big move, so I don't know how much weaker it really gets. You know, I would be kind of neutral at these levels personally.
You talked about energy being sort of the best part of your commodity strategy at the moment.
Well, most profitable this year, not necessarily the best part of the strategy, but yeah.
Fair. Where does green energy fit into the macro analysis?
So here's an interesting point about that. One of the reasons I'm concerned about inflation being around for you know, a longer period than people expect is our energy policies are green. And with climate change and things like that, maybe they really need to be. However, that comes at a cost of not having a lot of energy to use today. And with Saudi Arabia essentially sort of flipping us off a week or two ago, right? You know, energy's back, not at the highs, but it's back up in the 90s or something for crude oil. So that's pretty inflationary, and we don't have a lot of alternative sources of energy to use today. And Europe is in particularly the same situation, and that's why headline inflation in Europe is so high.
A couple of other questions while we have a few seconds left. Some macro managers, friend of yours, Paul Tudor Jones among them, have embraced Bitcoin.
Right.
Have you?
Well, we have, our traders can trade it, our trading systems can trade it. Our positions there are very, very, very small. I have to say, I don't feel qualified. I heard a speaker earlier today seemed to really know every bit there is to know about crypto and the infrastructure that goes with it. It's not my area of expertise. So I do recognize that there's going to be a pretty good opportunity set there, but it's not our area of expertise, and we try and stay away from things that we really don't have an edge in.
For my entire career as a journalist covering finance and financial markets, and even going back to before then, when I was in high school and maybe even elementary school, I remember people talking about gold as the ultimate inflation hedge. What the heck happened to gold?
It's been a dog. You know, it's you know, if there was ever a year people wanted gold to perform and to, you know, be an inflation hedge, it's down, I don't know, 10 or 15% or something, and so it's been pretty unimpressive. And I don't know if I can really answer the question of why, but I can tell you our quantitative models have tended to be shorted and done okay, not dramatically generating returns there, but a little bit of profits on the short side of it. And it just has been ineffective as a hedge.
Here's where we're going to finish up, and I asked you this question backstage, so I know what the answer is, but I'm always curious about how founders decide to name their firms. And I asked Ken, Graham Capital, where did that come from? And the answer is?
Well, I started Graham in 1994, and I did so with some help from my friends at Tudor, Paul Tudor Jones, and his middle name is obviously Tudor. Another old colleague is Louis Moore Bacon. I just sort of thought to myself, third time's the charm. My middle name is Graham. It's kind of this English thing. I'll go with it.
Ladies and gentlemen, please join me in thanking Ken Tropin of Graham Capital.
Please welcome to the stage Clearlake Capital co-founder and managing partner José Feliciano with Bloomberg's Jason Kelly.
All right.
All right.
Here we are. It's the afternoon. People mostly still awake? Mostly still awake. All right, good, good. It's the afternoon. You know, it's a nice day out. We're going to talk about your socks in a minute. Really nice to have you here. These are Chelsea Football Club. We're going to get to it. We're going to get to it. Might have heard of it. Anyway, really nice to have you here in New York. Came all the way across the country. You were in London last week. All right, so as I was thinking about this interview, thinking about the world of PE, thinking about the world of sports, but let's start in private equity, because when you name the top 10 or so private equity firms by assets under management, sort of get down and you're like, Clearlake. Google Clearlake. You have been surprisingly and very intentionally under the radar. Tell us about this firm that you founded in 2006.
Well, first of
That
all,
very few people know about.
well, first of all, thank you for having me here. Yeah, we so Clearlake Capital Group. We founded the firm in 2006. Today, we manage about 70 billion under management. About 75% of that is in traditional private equity, where we're investing primarily in technology, industrials, a little bit of consumer. We're a little bit unusual in the sense that we can do anything from a traditional buyout all the way to carve-outs, turnarounds, distress. And then about 25% of the AUM is in credit. All various forms of credit, everything from CLOs to direct credit to structured equity, et cetera, et cetera.
And so how do you come up with that playbook? You and Badad, he comes from TPG, you come via Tenenbaum and worked on Wall Street before that. What did you see in the market that wasn't there?
Yeah. Well, like every entrepreneur, we had the belief, maybe unfounded, that we had a different idea, a different way of doing things, a different way of looking at things. For us, it was having the experience of having seen or having invested, kind of going back to 2001, 2003, 2005, 2006. If you look back at that period, there was parts of that kind of economic cycle that were actually very healthy, and then we had periods of distress. And one of the things we noticed, being from the TPG vantage point, from the Tenenbaum vantage point, is that different firms were able to capture different parts of that cycle, but very few are able to invest across that economic and credit cycle. And we felt that there was an opportunity to create a firm that had a few elements. One, that was sector focused, not only one sector, but sector focused. And we definitely picked sectors very intentionally, sectors that we thought had significant secular growth, even if there was some cyclicality embedded in those sectors. But also, very intentionally, we wanted to have a firm that had the capabilities to invest across that economic and credit cycle. And that meant, understanding how to do a pure play buyout, but also understanding how to do more complicated deals. How to basically look operationally at a company that was doing a carve-out and executing on that carve-out, or looking at a company that required some help, a turnaround situation, and even kind of a little bit more esoteric, right? Or a little more unique capabilities of buying the debt and getting control through the debt in restructurings, primarily in a friendly way. And we felt that we could combine all that. We could create something that was unique and a little bit different. And looking back now, almost 20 years after founding the firm, I think we did capture a space in the market that was a little bit different. There are a few other firms that can do what we do, but very few at our scale.
And so you ultimately zero in, or really from the beginning zero in, tech, industrials, sort of consumer, but broadly defined. As you look across those at this moment in 2022, we've heard a lot throughout the day about, shall we say, some turbulence in the market. People have been checking their Bloomberg throughout the day and being like, okay. What do you see? I mean, what's the lens, or what's the sort of posture that you take in this market right now?
Yeah. Well, unlike our previous interview, I'm not a macro investor. So we look at things more from the micro perspective, looking at companies, more the idiosyncratic risk that we're trying to capture. But broadly speaking, obviously, we are testing the thesis, in terms of technology, right? Kind of underlying technology is, adoption trends, really interesting growth trends. Obviously, we can argue about valuations in the tech space, but by and large, those companies have been fairly resilient, and we're seeing that in our portfolio. In the industrial space, what we like to see is companies that can dominate their niche, that can have pricing power, that have the ability to kind of be not a price taker, but a price setter in their industries. And you look for things that are more resilient, where aftermarket is more important, where perhaps less capex, less capital intensity, things like that. We're gonna see some cyclicality there. We're definitely seeing the effects of the interest rate tightening that we're experiencing, and the slowdown in the economy. There's no question about that. In consumer, we actually have a very narrow lens, which right now we haven't done a whole lot of, but there's still really interesting aspects of that space. For example, our largest company in that space is a pet food business. During the pandemic, many of us decided to get a pet. And if you had a pet, you decided to get a second one, second dog or a second cat or whatever it is, and that demand has been proven to be very resilient. At the moment, what we're watching for is very quick, very intently is when is the right time to perhaps, start looking at more quote unquote turnaround and distress opportunities. I would say they're still early, right? Okay. I would expect a few more quarters of economic turmoil before it's really the buying opportunity is really there. Although, it's impossible in our industry, in my industry at least, from my perspective, to time the bottom, and you have to buy when you can.
Yeah.
So we're watching very closely right now.
And what about selling? Are you seeing opportunities to sell in your portfolio, or are you sort of holding still?
Yeah, well, it's interesting, right? I oftentimes people or our LPs ask us, when is the right time to sell a business, right? There's only one good time to sell, which is when you can. And at the moment, it's not a great time to sell a business, right? Why would you, unless you have to sell a business, why would you, right? We're in the middle of the storm. The syndicated capital markets, particularly in credit, are practically closed. We haven't seen an IPO in a long time. So it's really not a great time to sell the business unless you have to, or unless a strategic with a lot of cash, and there are many of them, approaches you because they feel they must have your business, right? So I think we will definitely look opportunistically at exits, and we actually have exited probably 3 or 4 businesses from our portfolio this year. But at the moment, right, we will do that very selectively, and only businesses where we think there's a significant amount of strategic interest. I think the private equity bid right now is not great, and the public markets are essentially closed.
Yeah. And when you think about, we've heard a lot today and over the past few days, it feels like there have been a lot of people out in the world talking. The financing market, like how do you find it? Because you're talking to banks all the time about their willingness to do things. I mean, there's obviously a very big transaction that needs to be financed very soon. But like, what do you see when you are talking with your colleagues on the banking side?
Yeah. So maybe I'll get a lot of emails and texts after this from my banking friends, because they'll say that their balance sheets are wide open and they're willing to back any and all financings. But I would say that the markets are very tight right now. The banks still have, it depends how you count, anywhere from $50 to $70 billion of kind of credit underwritings on their balance sheet, and on the mark-to-market basis, they're probably losing anywhere from $7 to $15 billion in those financings, right? The new par is probably like 85 to 90. So I think banks are going to be very, very cautious to take on significant, materially more credit or underwriting credit or underwriting risk before year end. And when you think about it, any transaction that you sign up in the next 3 to 6 weeks is probably not going to close until next year. Right. And keeping that kind of credit risk through the new year, oftentimes is something that kind of the risk committees and the credit committees don't want to do. Right. So I think you're going to see a pretty you're going to see very little activity, I think, in the financing markets, in the syndicated markets, in terms of new activity through year end.
It was interesting, trying to, get to the bottom of your strategy. You laid it out very nicely, and lo and behold, today you announce a deal. It's a really interesting one because it takes us into the sports arena a little bit. You acquired a business. You've got a platform called Victory Live, I believe. You acquired a new company as part of that platform called Ticket Evolution. I dare say everyone in this room has bought a ticket to a sporting event at some point. This is a really interesting business, and I think a window into consumer behavior in some points. It gets to sports, it gets to live events, it gets to how we literally consume in many ways. Tell us a little bit about that, just because it's so fresh.
Yeah. Well, I think, first of all, in many ways, it's the prototypical Clearlake type of transaction. As the founder of Victory Live is somebody that we have partnered with now going almost 10 years. Somebody that we were successful with in an earlier investment. We exited. The business that he founded is now essentially the core of what today we call NFL on Location. So somebody that we have known for a long time in a space that we know very, very well. It's also a space that we think is not only interesting for some of the things that you talked about, it's a space that, plays to our strengths, plays to the interplay of technology, data, consumer behavior, all the things that we think are, now, as we think about the world going forward, are extremely important to analyze not only consumer type businesses, but any type of business, right? Kind of every business arguably is a data business right now. Some of the most valuable assets that we have in traditional industrial companies is actually data, behavior data, maintenance data, and understanding that and having access to that is extremely valuable. That is data, after all, is the engine or is the source of any model that you think about that it's based on AI, right? You need the data first to be able to analyze it. So we think, as you mentioned, right, kind of a ticketing platform has many interesting aspects to it, but one of them is understanding or having a front row seat to that data and consumer behavior.
All right, sports. Got to talk about it. You wore the socks. If you go through, you go to your website, again, sort of look through, you're like, okay, interesting. Chelsea Football Club, what? This was not necessarily something that maybe people expected you guys to get into. And yet, as I've gotten to know you a little bit, this was not out of the blue. This was something that you guys had circled around and thought about. Take us into the thinking of buying a professional football club in London.
Yeah. Well, first, obviously, let's focus on the specific situation here. And for 1 second, right, I would ask you to proverbially close your eyes and suspend disbelief, right? It's and forget as Chelsea Football Club in the Premier League. We're talking about a situation where you had a forced seller, very unusual situation, right? Where basically the government of the UK essentially was forcing the sale of the asset. You had an asset that, even though most people would consider a price asset, but it was not really run as a business. It was really run for other purposes, but profit was not the ultimate, at least, goal, or not even one of the more significant goals of the business. At the same time, it's a business that most people will say is, kind of a beachfront property, one of the best properties in that sector, in that league, in this case. And again, when you think about sports, it's really the interplay. What are we really talking about? We're talking about live content, media, right? And how to monetize that media depends on some of the things that we're talking about: technology, data, right? Trying to understand consumer behavior. So we thought, essentially, so now go back to kind of, Chelsea, we thought we had a really interesting opportunity to buy a business in a very unique situation where, again, there was a forced seller, significant parts of the buyer market perhaps were not able to access, the transaction. And we felt that, all the core competencies of Clearlake came into play. On top of that, we were able to partner with, Todd Bowley and his group, a group that has a lot of experience, in other significant leagues and significant teams, the Dodgers, the Lakers, etc. So in many ways, it was, again, the prototypical Clearlake type of transaction where we had a great partner, a really interesting situation. We were buying at what we thought was a great, very interesting price, and a significant opportunity to transform the business and create a lot of value. And then if you add on top of that the overlay that the English Premier League, in our opinion, is one of the better leagues to invest, one of the ones with the most significant upside on a long-term basis, we got pretty excited about it.
Yeah. So a household name, to be sure, and as exciting as Victory Live may be, I'm guessing that you don't often have the experience that we had backstage, which was one of our team who was helping us get ready said, I'm sorry, did you say Chelsea? What's it been like owning something and sort of getting into the world, both here in the United States and in Europe and in London? As I mentioned, you were there just last week, to own an asset that is this public.
Yeah.
Given that we started this conversation about how not public you are.
Yeah. Well, it's been fascinating. Obviously, in the past 18 months, or let's say 24 months, we probably have done 6 or 7, probably done a dozen transactions, 6 or 7 of which had an enterprise value greater than the value of Chelsea. But you may, because you maybe did a little more research than most, but most people in this room will have no clue about the other ones, right? IPG, BBB, Cornerstone, nobody has a clue. But Chelsea, everybody has an opinion, or a lot of people have an opinion, particularly in Europe. I would say that we knew this was going to be a transaction that was going to be a lot more visible, a lot more high profile. We purposely have not been front and center in many ways in the transaction, and our partner Todd Bowley is the chairman of the business. He has done a great job so far of leading us through what was a very difficult transition, right? Ownership transition, and more recently a coach transition, which was interesting. I think that there's been some pluses and minuses, to be perfectly honest with you. I think it definitely has increased our profile significantly in Europe, Middle East, Asia. Here in the U.S., that's a little bit as well, though, obviously the football or soccer is a little bit less popular here than other places in the world. But, again, we're comfortable with it because at the end of the day, we think it fits very well with our investment strategy. And we think that the potential for value creation is very significant. And again, it fits very well with what we do. So we're very comfortable with it. It definitely is unique, right? When you get to watch every week and kind of get a feeling for how well or how badly you're doing, right? That's a unique perspective. Normally you wait until the end of the month to get the report from the CEO and the CFO. Here, you get to watch it on TV. But ultimately, what we're trying to build is a long-term sustainable business that can accrete in value significantly. And that means a lot more than just winning or losing at the pitch. That's important.
Right.
As a brand, as a media property, as a team, as a club. But we're also trying to establish and build or put in place the right building blocks to have a great business, kind of in 3 years, 5 years, 7 years. And a lot of the work that we're doing is behind the scenes trying to do just that.
And so, and it is notable, and I think important for people in this room to understand, if they don't, that you did make this investment through the fund, and this wasn't an individual. And so that does bring with it a different set of responsibilities, absolutely, I would imagine, and different because you're having to talk about this with your LPs, not just with like your family.
Yeah, no, absolutely. We think we have an incredible opportunity to double revenue. We think we have in our hands, one of the best media properties and sports properties in the world. Where we can get to $1 billion or £1 billion actually of revenue. We think we have hidden assets. For example, we have the Chelsea women's football club, and that's probably arguably a top 3 women's football club in the world. It's a completely undervalued asset right now. There's no reason why that property should not be, kind of producing several $100 million of revenue and in its own right being $1 billion plus, or at least a $500 million plus media property. So we think that there's a lot of opportunities, kind of embedded in the company that we bought. Again, it just happens to be Chelsea Football Club, a club that in some cases has fans that have been fans or the family has been a fan for 5 generations, right?
Yeah.
So that's what's unique, right? And we care about our supporters. That's extremely important for us. It's part of the DNA of the club, and we are not going to be successful if we leave our supporters and fans behind. So that's unique, right? Where you have a different type of stakeholder that you normally wouldn't have in other companies. But then again, we're used to having stakeholders. There's employees, there's customers, suppliers. In every company, you have different type of stakeholders. Just so happen that here, a very significant stakeholder is that support their fan base.
Yeah, but probably in your other companies, you don't have employees or customers like screaming at you on the street. But I don't know, maybe you do. All right, so I want to ask you this question that we posed to the audience as well, which is the best long-term investment is a team in which pro league? I confess I came up with this because I wanted to hear your answer. And so I dare say you may agree with this. So number 1, NFL, number 2, EPL. Actually, number 3,
pretty much a tie.
MLS, yeah, and then number 4, NBA. Okay, if you took this?
If I had to rank
quiz,
it,
yeah.
So we have a lot of respect for the NFL. It is probably the best run league in the world. The dynamics and the interplay and how revenue is distributed in each one of these leagues is a little bit different. So I would say that the NFL, if you take a generic NFL team, that may be the best investment in the world, right? You're 1 out of 32 teams, and you get 1 out of 32, 1 over 32 share of the revenue of the NFL forever. That's a great investment. I think the prospects for the NFL are fantastic, and the league has done a good job or a great job of addressing some of the issues that they have had in the past. I think the English Premier League, I think you have to analyze it a little bit on a team-by-team basis. Mm-hmm. But as a group of, or as a league, I do think that it is arguably has the most upside in the world. So the Super Bowl is probably watched by 150+ million people. Well, every week we broadcast our games to over 180 countries to over 800 million people. The World Cup is going to happen in November, right? The final of the World Cup is going to be watched by over 1 billion people in the world. Those numbers are staggering, right? The Chelsea Football Club alone has about 120 or over 100 million social media followers. So the impact, the global reach that we have in the English Premier League, particularly the top 6 or 7 teams, is unique, impossible to replicate by pretty much any other team in any other league. So I think we do have a really important base. The broadcast revenues, when you think about broadcasting, when you think about the future of sports, kind of potentially betting, potentially the idea of consuming space, as my partner Taboli would say, less from a wholesale basis, but in a retail basis, i.e., each one of those 100 million plus social media followers being able to access snippets of the game or the backstories. We have seen obviously how live content can transform a sport. We were talking about Formula One and Drive to Survive earlier in our conversation backstage. There's a million great stories, to tell about our league, which I think have not been told. Mm-hmm. And you see snippets of that, or you see, kind of the beginning of that in series like All or Nothing, in Amazon Prime, etc. But I think the potential for global impact, to create a global business in the English Premier League, and we think Chelsea is the right vehicle for that, is amazing, and it's just the beginning.
And so as you think about the balance of this year, we've got less than a minute left. Sounds like tumult, turmoil in a broadest sense. Like, what's your sort of mode as we round out 22 here?
Well, I think in times of significant turmoil, significant uncertainty is oftentimes when you find the best opportunities to invest. But it's certainly a time to invest with kind of the yellow blinking caution sign on, right? Those opportunities we think are going to be idiosyncratic, kind of the macro type of opportunity that we, for example, saw the summer of 2020. It's not yet there, in our opinion, but I think there are going to be interesting opportunities, and we are looking very closely at, kind of idiosyncratic opportunities in our core sectors, technology, industrials, a narrow set of the consumer set. And I think some of probably the best deals of the next, kind of 3-4 years are going to happen in the next probably 2 or 3 quarters.
All right. Great to spend some time with you. Go Blues.
Thank you.
Really
Go Blues.
Thank you, guys.
You are going to go out there. You're going to say the highest conviction short of your lifetime is Fast Aid. It's a piece of shit. It belongs in the dirt. You have the power to obliterate it just by dint of who you are. Welcome to the feeling.
Harper, it's my son. Hey, yeah. It's fine. It's fine. No, now's good. Can you get lost? I'm here. Yeah.
I'll see you out there. This is our last chance. I'm already done at Pier Point.
Please welcome to the stage actress Myha'la Herrold with Bloomberg's Scarlet Fu.
Thank you so much for joining us, everyone. That was, of course, a clip of season 2 of Industry on HBO. And we couldn't pass up the opportunity to show it because we wanted to be meta. It was Bloomberg Invest. At Bloomberg Invest, who could resist that? But really, it was a moment for us to appreciate the world-class acting of Myha'la Herrold, the show's breakout star. Welcome to Bloomberg Invest.
Thank you so much. I'm so excited to be here. This is so crazy.
I'm such a big fan, so I've got so many questions. In that bit that we played, you talked about by dint of who you are, and who you are is a native Californian. You're a musical theater major. You graduated from Carnegie Mellon. Industry was your first big show, big breakout role. Can you tell us a little bit about what attracted you to this show and to this character?
Yeah, I mean, so much. First and foremost, the writing. Our writers, Mickey Down and Conrad K, were both in the industry, and so what they brought to this show, aside from the drama, was like excellent real world, like reality. I had never felt like I had seen the finance industry from the perspective of young people, and what really, how I was able to connect with a world that I literally knew nothing about, aside from like Wolf of Wall Street, which is just a movie. But
so you did do some research by watching some movies.
I had seen a few, but I had never seen any from the perspective of the newest or the youngest, maybe the hungriest people in the business. And as a young actor starting out in my career, I really identified with this like deep, hungry need to impress, to succeed, to gain some kind of notoriety in my industry. I really understood what that felt like, this sort of like clawing to the top. And my character, Harper, sort of does it by a any means necessary sort of vibe. That's not really my go-to. I'd rather kill him with kindness, but I understood it. I respected it. I also didn't know that the world of finance had any people of color in it. Like based off of the media that I'd seen, like Wolf of Wall Street or, whatever, I felt like it was mostly the richest, the oldest, the whitest men. I didn't understand that everyone else exists. I look in the audience now and I'm like, you know what I mean? So that was really refreshing and really exciting to me that I got to bring my experience as a young Black American woman into this world, because we existed there and I had no idea.
Do you remember what the description of Harper was on the page when you got the role versus what she eventually became? Yeah. I'm curious to see how much of you or your experience is reflected in the character.
Yeah, I think the biggest difference between the Harper we all know now and the Harper that I first met on the page is that she was very outwardly nervous. Like there was a lot of like, clammy hands and darting eyes. She was nervous. She was overcome by her anxiety in the situation. And I just thought, in what world is this young black woman gonna step into this room full of people that she needs to impress while she's holding a massive secret. Like, I would never let them see me sweat. I just wouldn't. That's the training that I have had. You come into a room, you're like, this is where I'm supposed to be, you need me, and that's the end of it. You have to impress people. So I just decided that she's gonna walk in with confidence, and beneath that veneer, in her alone moments, in the moments when it becomes too much, you will see her sort of crack and crumble, and then we see the anxiety instead of it being on display from the get, because obviously she's gonna be anxious.
Right, there's a lot underneath, but it's still waters on top, right? There's a lot of furious paddling under the water, to mix my metaphors here. You mentioned Mickey Down and Conrad Kay actually worked on the trading floors in London, so they brought in that real-world experience. They did invite you to fill out the character, didn't they? I'm curious what they said to you and how you filled that role out.
I mean, really, they were like, for me specifically, they're like, we're not a 20-something Black American woman. So bring your experience in that way, which a big one was that sort of never let them see you sweat.
At her natural poise.
Yeah, absolutely. That was something that I was like, my instinct brings me here when I'm trying to impress people. And then on a really basic level, they were like, we're British and you're not. So if there's something in the writing, in something that Harper says that sounds very British, you can say it in a way that is not that, that's American. So that was mostly what I brought.
The construct is very, very specific. I mean, we meet Harper as one of several junior analysts on the trading floor. She's an American expat in London. She's young, she's Black. What was your impression of this world prior to your joining the show? You mentioned that you didn't know that finance had people of color, but I did the math, and it wasn't difficult math for me. You were 12 or 13 during the financial crisis in 2008. So did that leave you with any impressions of what the finance world was about, or what kind of impact it had on people's lives?
I mean, I was young, so not really, but I will just reiterate, like, what I knew as a sort of lay person to people in the finance industry was that there was, like, a lot of people in suits, like, in their tennis shoes on their way to work in Manhattan, and then putting on their nice shoes and changing their, like, dirty shirt from the outside to the clean one once they got inside. And then there was a lot of, like, sort of yelling, and then some of this, and then they had a lot of money. And that was pretty much it.
How accurate is that?
Is that right? Did I get that right? Do you change your shirt still when you get to the office? No. I see you say no, I don't do that anymore. Okay, maybe just in the 80s.
You mentioned that you mentioned Wolf of Wall Street. Did you watch any movies to kind of get a better understanding of how Hollywood depicted, you know, banks and Wall Street, and kind of contrast that with what the showrunners intended to do with industry?
Sure, yeah, I didn't, for the very reason that, like, this show was not that. I didn't necessarily need a contrast because I understood it right away on the page, just because of the perspective this show is coming from. Again, most of the other movies were like the oldest, most wealthy people who had been in forever, and that was not what I was doing, so I didn't need that as a sort of contrast. I really just pulled from my own experience of being like a starving New York wannabe actor, and tried to fill this. It's kind of the same, except the only difference is that, like, Harper's dealing with, like, bazillions of dollars, and I was never dealing with that kind of money. So it just raises the stakes, you know, but it's that same thing of, like, the relationships that you make with the people on the floor, the people who are coming in your class, and then juxtaposed with, like, your boss and that weird hierarchy. How do you impress, but how do you stay in your lane? Or, you know, I really just went for the emotional side because the finance still escapes me. It really does. And I'm not going to cap about that. I'm not going to lie and say I do my own investing and I know. Nope, that's not for me. I'm just an actor. I'm going to leave that to you guys.
How difficult was it to master the jargon? Because there are scenes where it's just back and forth and it's rapid fire and there's, you know, numbers flying all over the place, and one wrong word and someone does something different and billions of dollars are at stake. What was your process for that?
Yeah, one wrong word and they called cut. Yeah, the jargon was one of probably the most difficult thing to do because the emotion, you know, anybody can relate to an emotional feeling, but the words, the actual words were hard because they're not familiar to us.
Yeah.
So once I understood that I was never going to really grasp what I was saying, I just went for straight memorization, just like drilling over and over. If I have a sort of big section in, in season 1 and in season 2, there's a couple really big trades that Harper does that requires a lot of exactness in the words, and she's talking to multiple people. So I would just write them down and like write them again and write them again and write them again. You know when you get in trouble when you're in school and you're little and they make you write like, I will not throw bubblegum in class. I will not. Like it was exactly that, but with all of the
Bart
finance
Simpson
jargon.
writing on the board, right?
Yeah, it was very that. So it's mostly just that, mostly repetition, and then you just kind of have to force the words out of your mouth because they're so unfamiliar to us. Oh, to me. I won't speak for the rest of the cast.
Did you visit any trading floors or any banks in New York or London to get a sense of what the feeling, the buzz was like in a trading floor environment?
Yeah, so in the first season, we didn't get to go, but we did have a sort of Zoom meeting with a person at Bloomberg who sort of ran us through how the terminals like
Do you remember any
work.
functions?
No. No. On our show, they are not functioning terminals. They're actually just screenshots, maybe from some of you, that just rotate every 45 seconds, I think. But I remember watching this, and this woman was saying, and this and this and this, and this is what this means. And of course, in my mind, it was like static. I just didn't understand it. But what I did observe in the back of her screen was there was, you know, terminals everywhere and people working, and then someone would get up and have a conversation here, and another person would get and pass papers here. And I was like, there's so the floor is so alive the whole time. But this person was just like laser focused and doing all these things, and their mind was going a million miles an hour. So that's the thing that I took. I was like, Harper's going to be that laser focused, like she's so smart, things are happening all the time while this sort of chaos is happening around her. So I just tried to emulate that. And in season 2, we filmed in the London Bloomberg building.
Yes. Although it was
great.
supposed to be the Pier Point, New York headquarters in the show, right?
Yes, in the show, yeah. We used your building because it was the best one. No, I loved being in that building, though. You guys have the best snacks. Oh my gosh, what a gift.
Well, we are very grateful for the free advertising as well. What do you think resonated with fans, particularly in season 2, which was much more plot-driven than season 1, which was really about introducing Harper and her colleagues, especially the junior analysts?
Yeah. Everyone can relate to relationships, and I think most people love drama. So I think the thing that really captivated in season 2 is that because it was more plot-driven, because it was more character-driven, that people could relate in some way. Either they saw themselves, or they saw someone that they knew, or they were just there for the gags, the dramas, you know, who knows. But season 1 was cool because it sort of opened up this world, this your world, our world, and set it up in a way that we could go to more interpersonal, more familial relationships. And what I particularly liked about season 2, as we open up these characters and learn about their families and relationships, it informs the way they are at work. And I think, for me, it gave me a lot more sympathy, empathy for these people who I didn't know very well. It helps me understand your world and appreciate it more instead of being like, they have so much money. You know what I mean? Because people don't know. They don't know what you do. They don't know what you go through. And I was like, damn, if I had to do that every day.
So kind of an understanding of the stress and the anxiety that the day-to-day trading would really require or elicit in you.
Yeah, and particularly the youngest people who dream about this job or this world, and they're so hungry, and they'll do almost anything, you know, to stake their claim here. I was like, yeah, respect. I get it.
I read that you've described the industry fan base as a fiery sort of niche audience. Have they reached out to you? Have you gotten feedback from anyone unsolicited? I'm curious what they say to you about it.
Yeah, I love the fans of this show because they ride so hard for us. But some of the most impactful messages that I've received have been from other people of color, particularly women who are in finance. A lot of them said, I so appreciate that this exists just because now I feel like people know that I exist and that we are fighting in this world. There's a lot of people being like, I love braids on the trade floor, because I guess that doesn't happen that often. But yeah, just an appreciation for the visibility, for the representation, which is great.
And speaking of representation, you have this, your character Harper has this really interesting dynamic and relationship with her manager, Eric. Can you explain what it is about these two characters that draw them to each other and repel against each other as well?
Yeah, I think Harper and Eric relate to each other in the sense that they feel othered. Both of them feel othered, be it race, class, whatever it is. The way they deal in the trading floor, Eric must see a young version of him, a young, hungry version of him in Harper, and so he chooses to bring her in. And they are both playing in this sort of cruel game that although they have this kinship, they also use each other. They leverage each other against each other to sort of succeed in the game that is the entire trading floor, that is the industry. It's unfortunate because, at least in our show, I don't know about your world, but in our show, you can never know if anyone is like a safe place. Everything can be used for business or otherwise against you or for you. And I think those two really tiptoe that line. There seems to be, I believe there is, a deep love that they have for each other, but it's twisted because it's, in this petri dish of chaos and siloing and leveraging.
Yeah, they really relate to each other in a way, and I like what you said about being othered because Eric is a Chinese-American, also an American expat in London, and of course he sees something about Harper where he wants to sponsor her, he wants to mentor her. He calls her harpsichord. I mean, there's an affinity for each other that you don't see among other characters, which really captures a lot of attention. And also there's this dynamic between generations too, because Harper is Gen Z and Eric is what, Gen X? But this idea that they have different expectations of what you do in a workplace, what's appropriate in a workplace, and how you're supposed to perform in a workplace, your level of commitment. Can you talk a little bit about that? How intentional was that in the show to explore all those different dynamics between, say, a boomer, a Gen Xer, a millennial, a Gen Zer?
Yeah, I mean, I think it's part of the representative aspect of the show is that we're not just showing the people with the most money at the top, with the most power. We're not just showing the people at the bottom. We're showing a little mix of everything in between and how they all interact with each other because they don't exist without each other. But yeah, one of the things that I love about making Conrad as writers in the show in general is that it's not intentionally trying to tell you anything about the finance industry, about these people. It's just kind of like a slice of life. We're not trying to tell you, love these people, hate these people. We just want to show you a dramatized picture of what some of their lives look like. And that includes the youngest, the oldest, the newest, the most experienced. And it's just it's a perspective thing. And again, to show that all of them exist on the same floor at the same time under the same set of hierarchical rules.
With incredibly realistic dialogue to boot. How does your immersion into this world affect the way that you look at headlines that come out now on business or markets or finance? For instance, you film in the UK and Wales. The British pound has been plunging, for instance. I mean, when you look at a headline like that, because of your time spent thinking about this industry, does it change the way you look at things?
A little bit, but only in the respect that I'm like, oh, I kind of know what that means, and then I get tickled because because previously I was like, I don't know, that doesn't make, it doesn't matter to me. But in that situation, I'm like, oh, maybe now, well, even now I'm still like, I don't really know what that means. But now when I go, I'll travel to London and be like, the pound is down, which means my dollars mean what when I go shopping here? That's kind of where my mind is.
It's a good thing for you as an American.
Right.
I also want to ask you a little bit about this idea of whether finance is a meritocracy, because Harper, your character, seems to behave as if she believes it is. She's a rising star on the trading floor, right? She didn't go to Wharton or Stanford. She supposedly went to Binghamton.
Right.
I won't give away any spoilers, but do you think the show tries to portray finance as a meritocracy, or is it telling a different story about how privilege still determines your trajectory?
I think the show is doing exactly what it's supposed to do because you asked that question. It's not necessarily telling you it is a meritocracy or it isn't. It's asking the audience who sees this, is it? It's like asking you guys to ask that question. Me personally, I don't know because I'm not actually in it, but it's an interesting thing that someone like Harper, sort of coming with maybe less privileges than some of her counterparts, desperately believes that it is. I think that's because she thinks that's the only way she could really belong there. And I don't know if that's entirely true, because then there's characters like Yasmin who do come from some more privilege, more money. Her father has connections, and she gets in the bank, and she doesn't have the expertise that Harper has, and yet she's there. So I don't know, but that's what I love about the show, is that it sparks the
That
question.
debate.
Yeah, and then we get to talk about that.
Yeah.
I would love to talk about that with you guys and see what you think.
So that's an indication for you guys to tweet at us. Of course, be sure to hashtag Bloomberg Invest as well when you do so. Myha'la Herrold, thank you so much for joining us. It's been an absolute pleasure speaking with you.
Thank you so much.
Thank you.
Thank you, guys.
You can walk off, and then I'll give some closing remarks. And thank you all for joining us here on day one of Bloomberg Invest. We hope you enjoyed all the conversations. We, of course, want to thank all our speakers and moderators for making today such a success. And we want to take the opportunity to thank our sponsors as well. Crypto.com, first of all, and then Grayscale, Invesco, QQQ, and finally, our presenting sponsor is VinFast. Thank you so much for making this summit possible. And if you'd like more information on our sponsors, you can go to the resources tab on the event website. We're not done, of course, because there's day two of Bloomberg Invest as well. And whether you join us in person, hopefully, or virtually, we start at 9 a.m. And some of our speakers include Ares' Michael Arrighetti, Kathleen McCarty of Blackstone, and General Keith Alexander of IronNet. Now, in terms of coming up, what's next? If you're here with us in person, there's a networking reception just outside those doors right after we convene. And for those of you who registered to attend our opening night dinner, Bitcoin, blockchain, and broader crypto, that is sponsored by Grayscale, networking will begin at 5 p.m. on the 28th floor. We have staff who can guide you there to the 28th floor. And if you are tuning into that event virtually, we're happy to have you. Please scroll down to the next section on the agenda tab, and you can click to join the broadcast there. And of course, if you missed any of today's conversations, you can go to our website, BloombergLive.com, Bloomberg Invest, to view it on demand. Thank you so much, and have a great rest of your day.
Pretend